Shauna Smith alongside Jared Blickery. This is Yahoo Finance's flagship show, The Morning Brief, the ultimate guide to help you, the investor, make smarter decisions for your portfolios. We're tracking early session volume while bringing you today's top market themes and elevating Yahoo Finance's most popular newsletter.
And we've got a lot of ground to cover this Monday morning. Stock futures edge higher as investors await a new reading on inflation. Wednesday's CPI print is going to test the market strength, while the likelihood of rates staying for higher for longer is pushing the 10-year Treasury yield to its highest level since November.
And Q1 earnings season kicking off this week. Delta is set to report Wednesday before the bell, and that's going to be followed by a slew of big banks on Friday, including JP Morgan, Citi, and Wells Fargo. So let's get right to it with the three things that you need to know. Your roadmap for the trading day. We've got Yahoo Finance's Josh Schaefer, Madison Mills, and Rick Newman, who have more.
Hey, Shauna, stock futures edging higher to kick off this trading week. Nerves in the market, though, continue to run high following a hotter than expected jobs report showing signs the labor market is on firmer footing than many economists had predicted. The start of a new earnings season will test the market's strength with a slew of banks reporting its quarterly results. And investors will also be watching out to Wednesday's CPI data in hopes of more clarity on the timing of interest rate cuts.
And JP Morgan's CEO Jamie Dimon isn't seeing a soft landing. That's according to the CEO's annual shareholder letter. He lays out a number of risks to the U.S. economy that could cause, quote, stickier inflation and higher rates than markets expect. Among the issues he cites, the government deficit, quantitative tightening, and geopolitical tensions that he says could disrupt the commodity space.
Finally, Treasury Secretary Janet Yellen is wrapping up her fourth day of high-level meetings with Chinese officials. Yellen urging Beijing's leaders to restructure their economic growth plans during the Treasury Secretary's second trip to China in 9 months. The Treasury Secretary saying there is, quote, much more work to do in terms of diplomacy between the two nations. Other key concerns Yellen addressed include China's manufacturing overcapacity, trade practices, and support for Russia.
Today's top story, we are seeing some movement here in the futures market. This coming ahead of some key economic data that we are going to be getting later this week and Q1 earnings season, which is about to kick off. So let's take a look at how futures are trading ahead of the open. We're just about 28 minutes here until the opening bell, and you're looking at some gains here across the board. The Dow on track to actually open in positive territory now, so reversing the bit of the movement that we saw not too long ago earlier this morning. You've also got the Nasdaq 100 futures moving to the upside here, and the S&P 500 also pointing to gains at the open. When we talk about the S&P 500, the next critical level that many investors are watching on the street is 5,300. We have seen a number of strategists out over the last several weeks raising their year-end targets for the S&P 500. Wells Fargo becoming the latest out this morning. So again, some movement higher in the futures market. Let's also take a look at what is to come later this week, because starting off on Wednesday, we are going to be getting some key economic data. We've got CPI printout on Wednesday. Also on the earnings front, we're going to be hearing from Delta, the first earnings report, big earnings report of the Q1 earnings season. So very critical there. We can take a look at Thursday, a lot of key economic data that's also out. You've got initial jobless claims. That's going to be in focus, especially on the heels of that very hot print that we got on Friday. In terms of the headline number, at least, of course, you can argue the flip side of that, saying that we did see some improvement on wages. We'll also get a reading on PPI, followed by Constellation Brands. Constellation Brands will be reporting earnings on Thursday. And then Friday, it's going to be a busy morning for investors, for strategists out there, economists. We've got the University of Michigan Consumer Sentiment. That is going to be released on Friday, really giving us an updated view of exactly how consumers are feeling at this point. We know inflation obviously remaining much stickier than we had anticipated up until now. And then on the earnings front, you've got four logos here that is really going to be kicking off bank earnings for the first quarter. We've got BlackRock, Citi, Wells Fargo, and JP Morgan. So that's going to give us a better sense maybe of what we could be expecting this earnings season, and also obviously the first good look that we are going to be getting on the health of some of the largest U.S. banks here in the first quarter, Jared.
Yeah, we want to stick with JP Morgan Chase. The CEO, Jamie Dimon, out with a new shareholder letter. He's warning of several concerns that could shake a resilient U.S. economy. Yahoo Finance's Madison Mills joins us now to break down some of the takeaways, and a lot in here about artificial intelligence. And I think one of the key things is he's still really concerned about a lot of stuff.
He's concerned about a lot of stuff. That is very well said, Jared. And he kind of makes himself the Treasury Secretary a little bit here, and also the Fed chair. So interesting to see him taking on many hats, though not the president. No call-outs of a potential run for office that many have teased out in the previous years. Having said that, three main points I want to look at from this shareholder letter. The first, that the U.S. could face further interest rate hikes, something many on the street have sort of priced out. We're looking forward to a potential rate cut. He says rates could go as high as 8%. As you mentioned, Jared, he also talks about AI as the new printing press. And then lastly, his biggest concern among many that he cites is the government deficit. And that is part of what leads into his thesis that we could see rates hit as high as 8% because the government needs to potentially keep rates higher to pay off all of that debt that they've been accruing. And this is a call from Jamie Dimon that we've heard for years. He really doesn't like high government spending. So this is not too surprising here. In terms of what investors need to know, quick quote from him, markets seem to be pricing in a 70 to 80% chance of a soft landing. He says he believes the odds are a lot lower than that.
Yeah, and he sees rates going up as well. So thank you for that, Madison Mills. All right, earnings season kicking off this week with Delta reporting on Wednesday, then some of the country's biggest banks like JP Morgan, Citi, and Wells Fargo reporting on Friday. To tell us what the key themes we should be watching this season, we have Yahoo Finance reporter Josh Schaefer. So Josh, what are some of these key themes we should be paying attention to?
We should probably care what the CEO of the biggest bank thinks about interest rates, right, Jared?
Yes,
So you guys were just talking
agree.
about Jamie Dimon. That's obviously one of the key takeaways we get, especially for the next couple weeks, is just overall what these executives are saying about the state of the economy, about the path for interest rates, and how that might impact their business. One thing that equity strategists have been highlighting about this earnings season to think about is when you look at earnings projections for the year, they're very high right now, still at the end of the year. We're talking almost 17% growth in the fourth quarter compared to the year prior. If companies don't guide at that aggressive pace, we're going to see those earnings estimates fall. Then potentially that could also impact the market, right? So that's going to be one thing to watch. But I think the bigger thing to watch here is what we have at the top of the screen right now. Which sectors are seeing earnings growth? We've talked a lot about the broadening of this stock market rally in the last month. And are we going to see early signs of it? Now, strategists do not expect to see some crazy uptick that tech is not the leader in earnings growth. Tech is still expected to be the leader, but you can see from this chart here from Deutsche Bank, I think it sort of highlights nicely the trends we're looking for. So purple is mega cap growth in tech, and you can see they're expecting those earnings to fall slightly. By the end of the year, they think that line and this yellow line, which is the other, we'll call it the other 493 for all intensive purposes here, they're seeing that yellow line is eventually, hopefully, going to converge with the purple line. That lines up with earnings growth for your market breadth story.
Yeah, so then, Josh, that kind of leads me to the question I was going to ask you. And it's curious, just from your conversations that you've had with strategists out there in the street, when we talk about the slowdown that we're expecting to see in tech, you talk about the pickup that you're expecting to see in the other sectors. Walk us through just how that really also then supports potentially this further rotation that we could see, this broadening out that we have started to see over the last several weeks.
Yeah, so we've really seen a bet. I've been calling it a bet on the U.S. economy, right? A bet on economic growth with some of these sectors that have been picking up. Interestingly, we should highlight energy is not one of the sectors that is expected to post significant
But it's number
earnings
one
growth.
this year. It's up 17%.
Right, and then you look at the earnings projections, and earnings are expected to fall 14% year over year. But again, that gets back to bouncing back, right? It was actually worse last quarter.
It's all about the comps.
And then you look here, you see industrials posed to do well, and that's been a sector that has done well overall in the S&P 500 to start this year. But yeah, Sean, it was interesting. Binky Chadha had a great quote on this when I spoke with him looking out for the rest of the year. He said, price action is one thing, but at some point the fundamentals always matter. And you need the fundamentals to back this story that we've had, and then maybe it gives us more room to run. From a fundamental standpoint, of course, we know this Fed debate that we have going on right now could always change that as well.
Only price pays. I would just add that as a little footnote. Only price pays.
All right, Josh, great stuff. Thanks so much. We certainly are getting you geared up for what is going to be a very jam-packed week here on Wall Street. Consumer Price Index CPI data set to be released on Wednesday. Investors are hoping for some good news on inflation for the Fed to cut rates. And also earnings season, what Josh was just talking about, kicking off this week. Starting with, we're going to be getting Delta out on Wednesday, and then we're going to be hearing from some of the bigger banks. We've got Citi, JP Morgan, Wells Fargo, BlackRock, and State Street among the names of reporting before the bell on Friday. Now, last earnings season, nearly all of the larger banks posted a loss in profit as costs to attract deposits rose. Now, what can we expect this time around? We want to bring in Oh-Sung Kwon. He is Bank of America Securities, a senior U.S. equity strategist. Great to see you here, Oh-Sung. Let's talk about this earnings season. How much of this growth that we are anticipating, how much of that do you think has already been priced into the market at this point?
Yeah, and thanks for having me today. Great to be here. Yeah, so I mean, we are still pretty constructive on equities market overall. And I think it's really going to be an earnings-driven market, as Josh was talking about. Price action is one thing, but at the end of the day, we need fundamentals to really support that price action. And we think we're going to get that. We are calling for 12% earnings growth for this year, followed by another 10% growth next year. So 250 on the S&P earnings for this year, followed by 275. And I think that's a great setup for equities. Companies have already cut costs, and we have been getting better than expected data, macro data, over the past couple of weeks, which supports that consensus might be too low, especially this earnings season, and we're looking for another strong quarter.
So if I hear you correctly, what we are expecting coming into this is actually a little bit lower than what we might get. I just note last year, I follow all the analysts very closely, and your team, along with Savita Subramanian, was among the most bullish, and you were proven correct at the end of the year. What gives you this, conviction about the strength of the U.S. economy that leads to these earnings that you're looking for to grow in such a way?
Yeah, and I think the macro setup overall is very, favorable for equities in general. The economy is still very strong. Inflation is coming down, and the Fed is probably done hiking as well. We are probably headed to an easing cycle later this year, and if that's the case, then earnings are inflecting higher. Earnings grew for the second straight quarter in Q4, and actually accelerated last quarter. And that started happening even without much demand recovery. And the reason why we were in an earnings recession was because cost was bloated, and that's been taken care of. Companies have, cut down costs, started focusing on efficiency. We started seeing evidence of that. The other reason is because of the shift that we saw from goods to services. And that matters because for earnings, half of earnings for the S&P is goods, whereas for the economy is only 20%. So the shift that we saw from goods to services, that was a major headwind for earnings. And that's one of the reasons why we saw an earnings recession when GDP was still growing above trend. We're starting to see that reverse. We saw the ISM PMI coming in above 50 for the first time in like 17 months when the services PMI missed. So if the dynamics between goods and services starts to normalize, that's good news for equities, for earnings and fundamentals.
Oh, so talk to us just about when it comes to Bank of America, your team's base case right now. You have made the case, at least in the latest note here, that it doesn't really matter whether or not the Fed actually cuts in terms of the movement that we could see, the upside movement that we could continue to see in the markets. Why? Walk us through that thesis and why that essentially makes sense.
Yeah, at the end of the day, it's really earnings. And if the Fed can cut less because the economy is still strong, and as a bull, I'd rather much see the Fed cutting less because the economy is very strong than the Fed having to cut because the economy is weakening. And I don't think it's really about when the Fed starts cutting. I think it's really about how. Whether it's proactive first cut or reactive first cut. If it's a proactive first cut, meaning, the Fed starts cutting for insurance reasons, that's obviously bullish for equities. But if it's a reactionary first cut, the Fed having to cut due to weakening data, that's bearish. And as a bull, I'd rather much see, the economy continues to do better, and the Fed, staying more or less dovish.
Oh-Sung Kwon, we really appreciate you taking the time joining us here in Yahoo Finance. Look forward, hopefully, having you back soon. Bank of America Securities Senior U.S. Equity Strategist. Thanks, Oh-Sung.
Thanks.
Well, 4 days of top-level economic meetings between the U.S. and China coming to a close today. In Janet Yellen's second trip to China in 9 months, the Treasury Secretary saying that there is, quote, much more work to do in terms of diplomacy between the two nations. Secretary Yellen spoke at a press conference earlier today, recapping some of her conversations with Chinese leaders, specifically calling out concerns around China's economic strategies and the negative spillovers on the U.S. and the globe, including the country's desire to expand manufacturing in EVs, lithium-ion batteries, and solar. Let's listen.
And when the global market is flooded by artificially cheap Chinese products, the viability of American and other foreign firms is put into question. And we've seen this story before. I've made clear that President Biden and I will not accept that reality again.
Now, shortly following that presser, Secretary Yellen told CNBC at this point in a CNBC interview that at this point she would not rule out possible tariffs on green energy, saying, quote, we need to keep everything on the table. Joining us now with more going on and bring in Yahoo Finance's Rick Newman. And Rick, what's your reaction to the comments that we heard from Yellen in that presser, but also what she elaborated on just in terms of the fact that tariffs seem to still be on the table when it comes to green energy initiatives?
This went about as expected, I would say. There are some important things going on here for investors to keep in mind. People are talking about worries about a China shock 2.0 or a second China shock. So the first China shock was all the cheap Chinese imports that came into the United States and other countries around the world after China joined the WTO in 2001. And we recognized that the first China shock only after the fact because so much manufacturing left the United States. So when we talk about the second China shock, this is an effort to basically preempt another China shock in these other types of technologies and manufactured goods that, President Biden has decided these are very important to the U.S. manufacturing base, electric vehicle components, automotive components, things that are important to keep here in the United States. And that's what she's talking about. So China is just at about the beginning phase of ramping up these massive waves of exports of very cheap electric vehicles to Europe, to Africa, to Mexico, to South America. And there are worries that those could end up here. And if they do, they will significantly undercut the vehicles on the market here. So there is a very real likelihood that there will be some new U.S. tariffs going into effect. And let's remember, we learned from the Trump administration that the president can do this unilaterally. So President Trump was the one who called himself tariff man, but there is a very real chance that President Biden could be the second tariff man, putting new tariffs on some select Chinese imports, especially electric vehicle, automotive components, and possibly other types of green energy products.
And Goldman out today with a note talking about the economic implications potentially of more tariffs here on China goods. So, Rick, thanks so much for breaking all of that down for us. We really appreciate it.
Bye, guys.
We're just getting started here on the morning brief. Coming up, Elon Musk is saying that Tesla's robo-taxis are coming this summer, but will that be enough to help the company recover from its recent trouble? We are going to discuss that after the break. Plus, after years of buildup and anticipation, the great North American eclipse is happening today. A total eclipse of the sun is going to appear in the skies above the U.S., all the way from southern Texas to northern Maine. We will tell you which are the best places to get the best views and also some of the business implications for the companies that are impacted by this. And President Biden committing to a student debt relief plan that will help 30 million Americans. We will break down just what you need to know in our brand new show, Wealth. That's at 11 a.m. Eastern Time today on Yahoo Finance. We'll be right back.
Let's look at some trending tickers. Investors plugging into Tesla after CEO Elon Musk made an announcement on X, writing that the company will be unveiling a robo-taxi on August 8th. So for more on this, we're joined by Tasha Keeney, ARK Invest analyst. Tasha, always great to see you here. Thanks for joining us on a Monday morning. So I think by this time we're thinking, okay, August 8th, he must have it down. But we've been told about this, teased about this before in 2020, going back all the time when Elon Musk was talking about 1 million robo-taxis. So what should we expect on August 8th here in the great reveal?
Yeah, I mean, you're absolutely right that, one common criticism of Tesla is that they've been talking about robo-taxis for a long time. And the question is, okay, well, where is it? Well, I actually think we've seen a lot of progress over the past few years, notably in their full self-driving software that they released to consumers, and they just took that out of beta mode, right, and allowed a lot more people access to the latest version of the software. And what we're seeing in the videos that many people are posting online is that it's already possible to complete, nearly full drives fully autonomously, right? So there's still someone behind the wheel, they have their hands there just in case. It's not perfect, so that, it's not quite perfect yet, but I think that we're closer than ever. And I think that, we take confidence in all the improvements that we've seen in AI over the past few years as well. I mean, that has to help autonomous driving. We do see early elements of some things, some improvements that we've seen from large language models, for instance, bleeding over into the development work that's happening for autonomous driving. So we're really more excited than ever. I mean, we think this is going to drive the future value of Tesla when we look out 5 years. We think it'll be 2/3 of the enterprise value in 5 years. So we're super excited about it. Can't wait for August.
And Tasha, 2/3 of it is going to be driven by robo-taxis, correct?
Correct.
2/3 of the value.
Exactly.
Tasha, when using history as a guide here, from when Elon Musk has unveiled prototypes in the past, and then the timeline between that to when Tesla actually starts production, what does that timeline look like? And do you think it's going to be a similar type of timeline this time around?
Yeah, so they've said that they were planning on mass producing this car in 2025. We have heard a few things. There's I think two kind of separate things here, right? There's what they're talking about is the $25,000 car, which I think could actually be the same platform as robotaxi. And it's a question of like whether or not that's a car for the consumer versus just these cars are going in fleets that are then being operated by Tesla and potentially longer term an operating partner that owns and maintains the vehicles for robotaxis. So I think, that it's totally possible that potentially could be delayed from the initial timeline. But the real question is actually when the software will be ready, right? Because the Teslas that are on the road today already have the capability to be turned into fully autonomous vehicles, once those software updates are layered on and sent over the air. So I think, whether or not, the robotaxi prototype that we see gets unveiled on time is a question of when will they launch the robotaxi network. So I think that this announcement shows their confidence in that platform, which is really exciting. So that's what we're looking for the next 5 years. When can I take my hands off the wheel in my Tesla? And I think it'll be sooner than you expect.
I've been talking about this for 10 years on these programs, so it's nice to hear that it's finally imminent. Can you talk to us about the importance of IP that Elon Musk has talked about previously, and how IP is key to full service driving, which is key to your investment thesis here that it's 2/3 robo-taxis. What is the moat that Elon Musk has established for Tesla in the domain of intellectual property?
I'm so glad you asked that question, because this is really what we're most excited about for Tesla's opportunity in autonomous driving. They have an unparalleled data advantage compared to every other company that's solving for full autonomy. They just released on Twitter a graph showing the number of miles that they've collected, that customers have driven in full self-driving. We think that they get, access to roughly 2.5 million miles a day of customer data that they can potentially use to train their system. I mean, when you look at companies like Waymo, that are like passing roughly like a little over 10 million miles in the total lifetime of the project versus 2.5 million a day. I mean, that's unprecedented. And data is really key here in a lot of AI applications, proprietary data. And so we think that this is what could allow Tesla to be one of the first companies to scale. And that's really important because we think that the majority of the economics and robo-taxis, and this is actually in our latest Big Ideas deck that we published this year, our annual research deck, the majority of the economics will accrue to the players who are able to tackle, the first half of urban miles traveled with autonomous driving platforms. So I think, Tesla's both production scale, the number of cars on the road, as well as that data advantage, really, they're a dangerous competitor here. So I'd be nervous if I was another autonomous driving company.
Hey, I would be nervous too. And regardless of the results, it's just going to be fascinating to see how this plays out. And we enjoy having you at the front lines here. Thank you, Tasha Keeney.
Having me.
And another trending ticker that we're watching this morning, more trouble for Boeing. An engine cowling fell off a Southwest Boeing 737-800 mid-takeoff at the Denver International Airport over the weekend. The plane was towed back to the gate following the incident, which the FAA says it will investigate. And Shauna, my goodness, I'm hearing conversations with people, I'm having conversations with people who don't want to fly commercial flights when the maker of the plane is Boeing, and here we have another incident. If I'm on the plane and I look out and the engine's on fire, I'm second guessing my decision perhaps that I boarded a Boeing plane in the first place, and I'm editorializing here, but geez.
Yeah, and I think you're exactly right, because we also have to put this in context. This is far from the first issue that Southwest has had with a Boeing plane, even just over the last several weeks. Remember, it wasn't too long ago that the Boeing flight from Austin turned around mid-flight after a crew reported possible engine issues, and then there was two separate crews back towards the end of March that reported issues related to a flap and related to an engine. So clearly, when you see another headline like this, a real risk here is obviously for some more backlash, not only for Boeing, but for these airlines here, for passengers who simply don't feel confident in riding on these Boeing planes anymore. And this is just the long list of uncertainties that are ahead for Boeing, right? We talk about the fact that there's going to be further FAA oversight here just in terms of future regulations. You also have the labor negotiations. A new leader.
Who's going to lead the company?
Who's going to lead the company? And then also what the future of the company looks like, right? When you talk about the potential for a major acquisition as well. So there certainly are a lot of uncertainties on, I guess, on the plate right now here for Boeing. And that's a big reason why Bernstein was one of the analysts to say that the stock right now is in purgatory until they do resolve a number of these issues. Well, we are just minutes away from the opening bell on Wall Street. We will be watching the day's biggest market movers, among them Boeing and Tesla. We'll be right back. The opening bell on Wall Street happening just moments ago. Let's take a look at where we are trading here in very early action. When you take a look at the Dow, at least we're looking at some gains here as we try to regain
we'll get it. It'll come up there. There we go.
The touch. I've got the master here alongside me, so if all else fails, I'm just going to throw it over to you. But let's take a look at where we are right now. We've got the Dow up just barely to the positive territory here. You've got the Nasdaq up about 0.2%. The S&P also adding to gains at this point, pushing further above 5,200. We can take a quick look at yields. Obviously, bond market is going to be in focus this week. We've got CPI print, PPI print that's going to be coming out in a few days. More of a move to the upside.
Is a big number. That is a high number. Remember, we came off from what, 390, 395? Yeah. So a lot of movement in the bond market there.
Certainly, we're moving higher here again in yields. And then also let's take a look at the sector action at first. You're seeing some declines across the board when you have energy and healthcare under a bit of pressure, but take a look at some of the leadership there. You've got consumer discretionary, real estate, and materials among the leaders in early action today.
Value and cyclicals. But we got to continue the coverage of the day's biggest market movers. Yahoo Finance's very own Alexandra Canal looking at what stock investors should be watching this morning. So, Allie, what are you watching?
Hey, Jared. Yeah, we have quite a bit of movers this morning. I want to kick things off with Tesla. It is the #1 trending ticker on the Yahoo Finance page. Shares are up more than 2%, looking to reverse some of those steep losses that we saw at the end of last week. And it comes after Elon Musk posted on his platform X that robo-taxis will be coming August 8th. Obviously, Tesla is one of those volatile names on Wall Street. The shares are down more than 30% since the start of the year. There's been a lot of talk whether or not it should be kicked out of the Mag 7. But what Elon Musk says usually sways the stock in one way or another, which is what we're seeing this morning. Now, important to note here that Tesla has been talking about autonomous tech for quite some time. That ultimately hasn't come to fruition at this point. Tesla also faces some stiff competition, both domestically and abroad in China. So if they are going to go all in on robo-taxis, it's going to be a bit of an uphill battle there. But investors certainly seem optimistic at this point, given the upside to shares this morning. I want to take also a look at Boeing. This stock moving in the opposite direction of Tesla. Shares really moving flat. They were lower in pre-market trading right now. But this comes as this company just really can't seem to catch a break. Yet another event when it relates to one of its planes. The FAA is now investigating an incident in which an engine cover fell off of a Southwest flight during takeoff on Sunday, the latest in a string of very high-profile events that have plagued this company. Earlier this year, we saw a door panel flew off of an Alaskan Airlines flight. And Bernstein out with a new note this morning saying that Boeing has really been in purgatory on the heels of these events. That being said, though, Bernstein does have an outperform rating on shares across Wall Street. Boeing has 20 buys, 12 holds, and just 1 sell. So going to be interesting to track how this stock continues to perform. Shares are off about 30%. And then finally, I want to end on Coinbase. This stock climbing higher today, up more than 5% as Bitcoin prices rise above 72,000 a coin. We saw the crypto exchange close in the red at the end of last week after Cathie Wood's ARK Invest unloaded another $15 million worth of Coinbase shares across 2 of her ETFs there. But on top of these positive Bitcoin moves, Barclays this morning also raising the price target on Coinbase to $179 a share. That's up from $146, citing increased spot trading volumes. We know that a lot of these crypto exchanges, they move in tandem with the price of Bitcoin. So yet another name that we're going to continue to watch throughout the trading day this morning. Shauna?
All right, Allie, thanks so much for getting us caught up on some of the top trending tickers here on Yahoo Finance. Let's also take a look at another trending ticker, and that is shares of Taiwan Semiconductor moving higher after the Biden administration announcing that the chipmaker is going to receive up to $6.6 billion in federal grants as it gears up for a $25 billion expansion in the state of Arizona. Now, TSMC is going to invest more than $65 billion in total and add that third chip factory to the manufacturing complex it started building a couple of years ago, back in 2021. Now, when it comes to the importance of this, with projects like this one from TSMC here, Jared, the Commerce Department also saying that the U.S. is now on track still to make about 20% of the world's top chips, most cutting-edge chips, by 2030. Obviously, a massive priority here for the Biden administration.
Yes, it's all about what's being fabricated domestically, and we're talking 3 huge plants in Arizona. And I think it's necessary to understand the basic structure of the chip market here. When we talk about NVIDIA doesn't make their own chips for the most part. They farm it out. So Taiwan Semi is the one that invests in the technology that allows them to fabricate these chips. And Taiwan Semi, a very important customer, not only of NVIDIA, but also of AMD. And just the scale of this is astounding. Intel already got $8.5 billion in CHIPS Act grant. We're talking Taiwan Semi $6.6 billion, but also there's another $5 billion in loans. So we're talking about $11.6 billion to this one company. And it's just the scale of this is really impressive. If we can go to the Wi-Fi Interactive just real quickly here. Here's a heat map as we're looking at the semiconductor space today, but I want to show what's going on this year. And here's NVIDIA up 77.4%, and here's Taiwan Semi up 38.3%. And if we sort by performance, you can see the huge outperformance by names like NVIDIA, Supermicro, that's number 1 at 228%. And then Intel kind of in the dust here, down 23%, and Global Foundries down 16%.
All right, Jared, let's talk about the movement that we've seen in commodities, specifically gold, because gold moving to the upside again, on track for another all-time high today. This coming after the precious metal hit record highs of 6 of the last 7 trading days. So to break it all down and what investors should be watching in this space, we want to bring in Mike McClone. He is a Bloomberg Intelligence commodity strategist. Mike, it's great to see you here. Let's talk about, before we get into the specific price action, talk to us just about what exactly is driving the price of gold higher and whether or not that trend you think still has some legs.
Yeah, the answer is yes and yes. I think it's got a lot more room. The way I look at gold, it's just a matter of time it gets to 3,000. I don't want to admit I've been saying that for years, but it's finally breaking above that $2,000 an ounce level. And the foundation starts with the unlimited friendship between President Xi and President Putin. That shifted the world order. It's created a lot of people who are trying to get away from the dollar and focus on gold. So the largest pockets on the planet, central banks, i.e. China and some India, are buying gold, continuing to do that. And I see that continuing. I don't see what stops it. And what's really unique about gold is it's the only major commodity that usually goes up over time that's really making new highs versus all the other commodities are kind of bumping up against ranges. But what's really unique is there's been significant outflows in gold ETFs. But they've reached a level now that's pretty good support. I think it's about time those outflows flip to inflows, which would accelerate the gold rally.
Yeah, it's been really fascinating for me to watch this because it looked like over the last 4 or 5 years, gold was just poised to break out in a big way, and each time it was a disappointment. It was a false breakout. What gives? And here's a chart. Well, let me just do a little technical analysis here. This is a 5-year chart of gold futures, and you can see we just accelerated to the upside. Simple measured move is putting this at least 3,000. What do you think when you look at the technicals here? You've already outlined a bull case, but anything in particular in the gold futures or silver metal just really stand out to you that finally it is now popping versus the last few years?
Jared, you point out a classic technical position. It's basically called maximum disdain. You have to frustrate the bulls as long as possible and then finally go up when they kind of give up. And that's really what happened. You look at commitment of traders, which is managed money net futures positions, kept bumping up against resistance, and finally it's breaking out. It was nowhere near overbought. So like you said, I see gold now is just about 2,000 resistance, which was a resistance, now converting to support. And now what's going to take to get to $3,000 resistance? The key thing I like to point out about gold is I have to repeat the same thing I've been saying for years. It's really, I think, somewhat risky to hold gold anymore without some Bitcoin in that space as the world gold's going digital. So the fact is, just this year alone, there's been about $7 billion of outflows in gold ETFs and about $12 billion in the new Bitcoin ETF. So there is a flip there. There is potential that gold did demonetize silver, and Bitcoin is in the process right now, maybe early days of potentially demonetizing gold.
Mike, let's talk about another commodity that is certainly on our radar and one that has been trending at Yahoo Finance, and that is crude. This movement that we have seen higher in the price of oil over the last couple of months. Do you think we're going to, there's lots of talk about the fact that we could get above 90, we could head closer to that $100 a barrel level. How likely is it, do you think, that we're actually going to push up against those levels versus maybe falling back to some of the lows that we saw not too long ago?
much more to lather. When you say crude oil, the first word we should say is autocorrelation. So you look at the price in the screen right now, $86 a barrel. That was first traded in October 2007. Since that time, gold's up 210%. So there's a bull market, and here's a languishing bear market. So the way I see crude oil is I don't think it's coincidence that crude oil bumped up a good bunch above that 83 level, which I thought was a good threshold last week, and the S&P 500 tilted lower. See that risk now? The risk is for crude oil is really beta. If the stock market has a normal correction, crude oil is going to 50, which is what I see WTI going to 50. It's not profound at all. That's been the highest volume, the kind of the pivot mean for basically almost 15 years now. So I think we're at the upper end of the range along with copper. And here's a key fact is on the year, I'd say a 1 year basis, the S&P 500 total returns around 30%, and total return for the Bloomberg Commodity Spot Index, the Spot Index change is minus 2%. You have to ask yourself, what's it going to take with stocks going up that much and commodities going down? So the key thing I'll point out, as I'll end with, is we do have commodities getting cheap historically versus stock market. We've been pointing that out for years, but the risk is that the stock market rolls over a little bit, and high crude oil is not good for the stock market.
Mike McGlone, we really appreciate you taking the time joining us here on Yahoo Finance. Mike McGlone, a Bloomberg Intelligence commodity strategist. Thanks. Well, coming up, we are going to dig into how retail investors are trading, some of the trends in a new report out from Charles Schwab. We've got that for you after the break.
Two stocks investors are keeping an eye on, Tesla and Apple. Tesla is the biggest loser year to date in the S&P 500, down about 34% as of Friday. Apple down 12%. Now, a new report from Charles Schwab shows that they continue to remain popular among retail investors. And let's bring in now Joe Mazzola, Charles Schwab Director of Trading and Education, to discuss more. Joe, not a big surprise here. We have what we call Yahoo Finance trending tickers, and it's based on the traffic to all our ticker pages. And guess what? NVIDIA, Tesla, Apple, almost always rounding out the top three here.
Yeah, no, I think with NVIDIA, you can make the case that AI remains strong amongst the investor base. They want to participate in that, and NVIDIA is the leader of the pack there. And I think with Apple and Tesla, I mean, look, retail investors tend to look for dip buying opportunities for names that they've owned in the past. And when you look at the performance of those two names, clear underperformers in the Mag 7 at this point, they're looking for chances to buy those stocks at a discount from where they were trading just 3 months ago.
Joe, what's driving that investor confidence that you clearly are seeing over the last several months? And then what is that, when we look ahead to the future, what is that indicative of just in terms of some of the future trends that we could potentially see?
Well, let me just throw some numbers on there. So the stacks number that we came out with, and remember, this is based upon activity. So this is behavioral index as opposed to attitudinal, jumped up to 5165 this month, or this past month in March. That's an 8% jump over February. Takes us to levels that we haven't seen since May of 22. Now, to put that in context, it's still well below the levels that we saw in the meme stocks of 2021. But it might take a while before we see something like that again. So it is in it's in a range where it's starting to show a lot of investor confidence, and I think a lot of that has to stem from the economy showing a firm stance, and that it doesn't look like a recession's around the corner. I think you came out of a Q1 where earnings beat expectations fairly handily. Expectations I think were a little bit low from the analyst community, but the earnings beat was good, and investors are looking for a couple of factors. We talk about multi-factor analysis. Two of the factors that we hear and that we talk about with our investor base quite a bit is positive earnings revisions. So you look at a company like NVIDIA that, they're leaders of the pack there. But a couple other things like free cash flow and then interest coverage ratio, meaning are they generating enough profits, revenues, and cash flow to pay off that debt, especially when you're seeing interest rates at these levels. Those are becoming extremely popular factors for our investors to look at.
Well, since we're heading into earnings season right now, let me just ask you, on the cusp of earnings season here, so what trends do you think, you've been putting out this survey, or basically you've been gathering these statistics for some time, do they say anything about what we should expect for the current earnings season?
Well, I think one of the things to expect when we're looking at the sectors that were purchased in March, IT was a clear favorite. I mean, way above some of the other sectors, but we did see some net buying in healthcare, and we did see some net buying in utilities and materials back in February, and those turned out to be prescient buys, kind of given what they did in the month of March. So it's really staples, healthcare, and IT for March were the biggest inflows. We did see some inflows in fixed income as well too. Now I will say this: I think that relative to maybe the Q4 earnings that came out in January and February, Q1 earnings, the bar's a little bit higher. We're not seeing the analyst community kind of lower the bar to the same extent that they did for the last quarter. So the bar's set a bit high. We'll get a better indication of that. It's kicking off this Friday with a lot of the financial names, but I think it's kind of put up or shut up time right now for the market, kind of given some of the valuations.
So put up or shut up time right now for the market show. Real quick, let's talk about some of the activity that we've seen, or interest, I should say, in some of those traditional meme names. The volatility that we've seen in GameStop, some interest again in AMC, and then you put Reddit into that category following its IPO. Did that at all show up in your index and some of the activity? And if not, I guess, what does that tell us just in terms of the split that we're seeing between the retail investor versus what we're seeing on the sell side?
So I think one of the things that I found very interesting when I looked at the net sales, number one on the list was Coinbase. So it's a bit of an ancillary play from kind of what you're talking about there. But, Bitcoin, with the rally that it had in Q1, Coinbase was up almost 60%, before the pullback that we saw in March. And clients trimmed into that. And I think one of the big differences, like I said, between this time right now, we even seen that 8% bump in the stacks relative to maybe 2021, is clients are more discerning when it comes to some of those SPAC names, and they're a bit more discerning when it comes to the meme names. I think, if you go back to 2022, look, I mean, they got burned a little bit on those names, and they're not scooping them at the same levels that we maybe saw them in the past.
All right, we've got to leave it there, but really appreciate your insights. Joe Mazzola, Charles Schwab Director of Trading and Education. All your markets action ahead. Stay tuned. You're watching Yahoo Finance.
Netflix getting two bullish calls ahead of its upcoming earnings report. Now, the analyst teams at JP Morgan and also TD Cowen both raising their price targets on the streaming giant. TD Cowen raising its price target to $725. That's up from $600. JP Morgan raising their price target from $650 or to $650 from $610. And Jared, when you take a look at these two calls, the basis, it seems, for both of them are the healthy subscriber trends that we are seeing right now within Netflix. And to dive into that a little bit deeper, JP Morgan making the case that about 62%, so over 60% of Netflix borrowers they think are going to convert to paying subscribers over time. They're confident that Netflix can monetize 36 million borrowers by the end of this year. 43 million by the end of 2025, and TD Cowen making a similar bullish case just in terms of the subscriber trends, and they actually think Netflix will be able to add more subscribers than what the street consensus is at this point.
They got me. I was a borrower, and now I'm a subscriber.
You're a borrower? That's actually shocks me.
I was until about a year ago. Yeah, well, they got me. Anyway, I'm happy to pay now as long as I like the content. But just another statistic here: Netflix has really been good at monetizing these quote-unquote borrowers. So that was 13 million of the 30 million total net adds last year were borrowers. And I was looking at a chart. In fact, let's go to the Wi-Fi Interactive. I have our streaming heat map. This is year-to-date prices. And one thing that I'm noticing, Apple, okay, so one of the big guys, Apple here, is down 12%, but the other major players are really just dominating. And maybe that's just because we are in a mega cap favorable environment. But you take a look at Disney. This is a company that's really bounced back. Netflix, also kind of a turnaround story. Let's not forget, this stock was 75% down. That is an incredible drawdown to experience here. And it's just about clawed, what, 80, 90% of that back. So that's really impressive to see a company turn around like that. I'd throw Meta. The chart looks pretty similar to that one as well.
Which Netflix level ad tier did you subscribe to? Are you the ad tier?
Oh, I don't. I subscribe to the main one, but no, I'm not on an ad tier. But I was.
See,
a
they
borrower
converted
before.
you exactly, and that is what more and more analysts are saying, that
Yes.
some of those that they are going to convert aren't necessarily converting to the ad tier. They're actually paying up for the ad-free tier, and Jared, I guess, being one of them.
Put me in that bucket.
All right. Well, coming up here in the next hour, we have a stocks here moving to the upside as Wall Street kicks off a very busy week of both econ data and also the start of first quarter earnings season. Then the Oracle of Wall Street, that was dubbed by Bloomberg about Meredith Whitney. She's going to join us to talk about housing, fixed income, and much, much more. Plus, get your Eclipse glasses ready. We will talk all things solar eclipse and satellites with the CEO of Planet Labs, Will Marshall.
And make sure to stick around for The Wealth at 11 a.m., where Rochelle Akufo is going to be discussing intentional financing, financial planning. Stick around. This is Yahoo Finance.
Welcome back to Yahoo Finance. I'm Shauna Smith alongside Madison Mills. We're just about 30 minutes into the trading day, and here are the three top stories for you at this hour. Well, stocks are on the move to the upside. A strong econ data is causing some doubts to creep in about the Fed's rate cut path. Friday's hotter than expected jobs report and also forecast for stickier consumer price inflation has some traders forecasting maybe we could only see 1 or 2 cuts before the end of the year. Also a handful even betting that the Fed could hold rates steady through year end. Despite all that, though, we're still seeing some movement to the upside for the major averages.
And Treasury Secretary Janet Yellen ending her 4th day of high-level talks in Beijing. Yellen urging China's leaders to restructure their economic growth plans, saying there's, quote, much more work to do in terms of diplomacy between the two nations there.
And JP Morgan Chase CEO Jamie Dimon issuing a warning about sticky inflation and higher for longer rates in his latest shareholder letter. The CEO naming government spending, the Fed's shrinking balance sheet, as well as ongoing geopolitical risk as significant forces that cause him to remain cautious. Now let's start the day with those comments from JP Morgan CEO Jamie Dimon in his latest letter here to shareholders. The CEO covering a wide range of topics here in his 61-page letter, including the possibility of higher for longer rates, AI, and the government deficit. This, of course, is ahead of the company's earnings results on Friday. And Maddie, when you talk about the importance of this letter, obviously many shareholders, investors really parse through this shareholder letter just in terms of getting a better sense of how Jamie Dimon actually views not only the market right now, but really the U.S. economy as well as the global economy. And what stuck out to me in the shareholder letter is the fact that he started all of this talking about AI and the significant impact he sees AI having, not only on companies here in the U.S. and globally speaking, but really what it means for the human race here in the future as well.
He really zeroed in on that, and it's not too surprising because he had teased out previously that he thinks AI could lead to a 4.5-day work week, so love to see that from Jamie Dimon. I do want to apologize for what I said in my earlier hit. I was saying that Jamie Dimon was taking on the Fed chair role in this letter by saying that rates could go as high as 8%. I no longer agree with that, having read through more of the letter. I think this is more of a risk manager's take on the market. He's saying that JP Morgan is positioned well whether or not rates go down to 2% or 8%. And that makes sense given where this bank has been historically. They became the biggest bank back in 2011. They have the highest assets under management compared with all of the major banks. Really important context there heading into Friday when they get their earnings print out. So yes, he's saying that we have all these risks, but at the same time, they're probably going to have a banner earnings print coming out on Friday. So more evidence that he is handling that risk well.
Yeah, certainly. And also what caught my attention was what he had to say about the economy's soft landing and the odds that we could see a soft landing, and really pulling directly from the shareholder letter. He's saying that the market seemed to be pricing in a soft landing at about 70 to 80% chance, modest growth along with declining inflation and interest rates. He actually believes that the odds are a lot lower than that. So certainly some interesting points made, as always, in this annual letter to shareholders from Dimon.
Absolutely. Well, we are going to continue to look at today's market moves. Stocks are muted to start this busy week on Wall Street. We're getting lots of economic news this week, and strong data is causing investors to sort of pare back their rate cut expectations at the moment. That's why we're seeing mixed movement across the major indices there, but more traders are now expecting just 1 or 2 rate cuts this year. That is below the Fed's median forecast of 3/4 basis point cuts. Expectations for CPI coming up on Wednesday indicate that prices are expected to remain sticky. So the big question, are 3 rate cuts still on the table? Joining us to discuss, we have Willem Sells, HSBC Global Private Banking and Wealth Management Chief Investment Officer. Willem, thank you for being here. I want to start on getting your reaction to something that Jamie Dimon said in his letter, that the market sees a 70 to 80% chance of a soft landing. Jamie Dimon saying he sees much lower than that. What percentage would you put on the chances of a soft landing here?
We are in the soft landing camp, and we're also in the camp of 3 rate cuts. We think that we've seen enough progress on a number of elements within the inflation basket for the central banks around the world, actually, not just in the US, to have the confidence that with the the tight with the higher interest rates, they can start to ease those. Remember that we now have a real rate which is quite restrictive still, so they can start. We think that it will be the ECB, the Fed, and the Bank of England all joining in June, but probably with the ECB having the highest probability. The market's now assigning slightly lower probability to the Fed doing that. But we stick with 3 rate cuts for the Fed as well.
Well, if we don't see those 3 rate cuts, can markets still trend higher?
Well, the equity market obviously, is taking the positive other side of the coin as well. Why do we have that, somewhat more sticky inflation? It's because activity is, quite strong. You're seeing actually from a global perspective an uptick in PMI indicators, and what is new is that you're starting to see, some uptick in goods demand as well, especially since, inventories are also low. So in a lot of the PMIs, you have seen that gap between goods demand minus inventories widening. And obviously, if you have demand but you don't have the inventories, you have to produce more. That is going to lift GDP, and therefore that obviously excites the equity market.
Well, let's talk about that lift to the GDP then, because a lot of the notes have been calling this a period of non-inflationary growth that will kind of fuel earnings without pushing the Fed to be too hawkish. Do you buy that narrative?
Well, if you look at the central bank's narrative, all 3 central banks that I mentioned, the Fed, the ECB, and the Bank of England, all had that implicit tone, or even explicit in some cases, that even though inflation will be a little bit stickier and may take longer to come down, there's enough of the elements within the inflationary basket that come down for them to have confidence that they get towards their target. Remember, they don't have to be at 2% before cutting interest rates. They just have to have enough confidence that we will get there. With that real yield that is still quite a bit above the inflation, you are going to have the impact on inflation and make that come down. So that's why we think they will act in June.
Well, and what do you think will give them that confidence in order, though, to cut in June? What is that key thing that they're looking for, just in terms of a critical level or some sort of a continuation of the downward trend that we've seen in inflation, to convince them that, hey, it's okay to cut at this time?
But to a very large extent, it is the labor market, right? It has always been about the labor market, because first goods price inflation fell, but services inflation, continued to be quite sticky. So they, in the US in particular, they look at, rent, because that's a big part of the CPI basket that has eased a little bit. The other thing is the labor market, where you're starting to see, that the gap between supply and demand in the labor market shrinking, and Powell has also, pointed to the fact that, there is increased labor supply, in part coming from immigration, in part also, coming from a higher participation rate. So we're still in that sweet spot, I do think, where you have indeed that combination of relatively resilient economic growth, good earnings, as well as that prospect of, rate cuts. Even if it is delayed by 1 month, which we don't think it will be, that's not the end of the world for the equity markets, as long as those earnings continue to come in as we expect.
So I'm curious about what sectors and names specifically you see having and being poised for more growth, because we're seeing that a lot of the interest rate sensitive sectors are the ones that are in leadership positions right now. So does that change this earnings cycle for you? And does that change the names that you foresee having more of the outstanding growth this earnings cycle?
So certainly up to the first month or so of the year until mid-February, the leadership was, with the interest rate sensitive sectors. What you've started to see since the middle of February is kind of more of a matching between value and growth stocks, and even maybe value stocks increasing a little bit in that, in terms of performance. And that's in line with our strategy to broaden out the sector exposure. We continue to like IT because of the structural support and the innovation that is going to come from AI, but that's going to broaden out into other sectors. So when you look at earnings growth and earnings momentum, where analysts are upgrading earnings expectations, it's not just in IT, but it's in communications as well, it's in industrials, and it's in financials. And we very much overweight those sectors, because we do think it's going to become more difficult to get a lift from price earnings ratios, so from valuations. It needs to come from earnings. That's why we focus on those 4 sectors where you see that earnings growth.
All right, Willem Sells, always great to have you. Thanks so much for joining us here this morning. We have HSBC Global Private Banking and Wealth Management Chief Investment Officer. Keep right here on Yahoo Finance. We've got much more of your market action ahead. Again, we're about 40 minutes into the trading day. You're still looking at gains across the board. The Dow just above the flat line. We'll be right back.
JP Morgan Chase CEO Jamie Dimon is concerned about a number of risks to what he sees as a resilient U.S. economy. Dimon voicing some of those issues in a new shareholder letter out today. He said the bank is prepared for interest rates going anywhere from 2% up to 8% or more. So what question could that raise for mortgage rates? Here with more is Meredith Whitney, CEO of Meredith Whitney Advisory Group. And Meredith, thank you for being here this morning. I'm curious what you think a higher for longer rate environment could do to the housing market if we do see the Federal Reserve not only keep rates higher for longer, but also potentially even raising interest rates further.
Well, that's a base case scenario that I'm assuming that rates stay higher longer. So regardless of what the Fed does to the short end, I think long end rates stay higher for longer. So in terms of the housing market, it has, for the little activity that has gone on within the housing market, it hasn't impacted the housing market that much. So 38% of homes were were bought with all cash last year, according to Redfin. And so you're seeing a lot of activity going on in the housing market, regardless of where rates are. Certainly, if rates come down, you'd see more housing activity. I think longer higher rates drive housing prices down. But that's in a backdrop of housing prices coming down anyway, just because of supply-demand dynamics.
So, Meredith, when we take into account some of the dynamics that are at play right now, the likelihood that we actually will see prices either lower or actually move higher if we don't see a significant improvement in supply, what are the odds of each? And I guess, how do you see that then overall, the impact that is going to have on the real estate market, on generational wealth here for decades to come?
Wait, so the odds of what? The odds of rates staying higher or the odds of home prices going lower?
Pricing.
From a pricing perspective, here's how I look at it. So you have a disproportionate amount of housing. Over 90% of housing is owned by households over 40, and over 74% of housing is owned by households over 50. Over 56% of households of housing is owned by households over 60. And so you're going to see downsizing either because of empty nesting, and that's a natural cycle of downsizing. So over 51% of people over 50, households over 50, downsize according to AARP. But you also see, and this is something I've been working on a lot lately, which is an increasing financial strain amongst households over 60. So you've seen a big jump in overall debt loads carried by households over 60. And as a proportion of total debt, that's doubled over the last 20 years. So I think you're going to see, due to financial strain, more seniors having to downsize, and that's going to put more supply in the market. So what you've seen and what's kept home prices so high for the last 3-4 years has been lack of more demand than supply. And I think you're going to see that invert with more supply than demand over the next 15 years. And that's going to start to happen over the next the next couple of years.
I'm curious then, Meredith, what the catalyst will be for that drive in supply. And I want to pull up a quote here from the Dallas Fed about the impact of mortgage rates versus prices. They said that as of September 2023, the average rate for homeowners was only 3.9% compared with 7% on new mortgages. So basically the idea that interest rates are not necessarily having a read-through impact to homeowners because they're staying in, they're locked in on mortgage rates that are a little bit lower. So then, what would be the catalyst moving forward to change that dynamic? Is it going to rely just on supply? Is there another maybe policy change that could be enacted to change that dynamic?
Well, that's a really good point, because a lot of the demographic shifts have been, you could see the demographic shifts coming from a long way away. And what changed a lot of that in the 90s. So in the you saw a big boom in housing from the baby boomers, and what really accelerated the housing boom was a change in policy by Clinton and Frank Raines during the early 90s. So it increased home ownership from what had been historically a 64% rate to almost 70%, and you saw a massive housing boom and a subsequent housing bust. When homeownership rate then retraced below natural levels to around 63%, we're about up to 65%. So I don't know that there would be any type of regulatory policy change because the scars of the great financial crisis are still very raw for a lot of people. So I don't know that there's a policy change. Biden enacted or proposed a $10,000 a credit to home sellers. That's not really that much when you think of home values, average home values well over 400,000.
Meredith, has there been any sort of policies floated by policymakers recently that you think would better address, or how would the administration better address this housing affordability crisis?
Well, I mean, letting home values naturally to come down. So you could have over a 30% move in home prices, and that's just retracing to pre-COVID levels, and without a lot of collateral damage. That certainly would make homes a lot more affordable. And I just think you have to let nature take its course. And again, the math is, I saw you had Barbara Corcoran, the Grand Dame of real estate on. It's hard to argue with her, but I just look at the math in terms of, potential home buyers, potential home sellers, and the math is disproportionately weighted towards potential home sellers.
Yeah, we were going to play a clip because you guys disagree a little bit just in terms of where exactly the market is heading in the short term. Meredith, real quick, before we let you go, and I know the last time you spoke to Yahoo Finance, we asked you about the risk of recession. Right now, you're rather confident that the U.S. economy was going to be able to avoid a recession here in 2024. Is that still the case?
Yeah, I break it down to this. So over 2/3 of what drives the overall economy, which is 2/3 of GDP, which is consumer spending. Over 2/3 of that is driven by the high end. So households that make over $70,000 a year. And what you have with the lower end has been really a lack. So we're beyond a year worth where stimulus ran off in terms of extra payments to people on entitlement benefits. And so you've already seen that pass through the economy. And that was really felt by the dollar stores last year. That's anniversaried in. So I think you see a steady state with households under 70,000 a year, and really no feeling of pain with households above 70,000 a year. And in addition, we're in an election year where the administration is incented to increase government spending, and they've certainly done that.
Meredith Whitney, always great to get your insight here. Thanks so much for taking the time to join us this morning. CEO of Meredith Whitney Advisory Group. Thanks.
Thank you.
Let's get to a trending ticker here on Yahoo Finance. Spirit Airlines moving to the upside, up just about 2% after the airline announced that it has reached an agreement with Airbus. They're actually going to delay the delivery of new Airbus family aircrafts that were initially scheduled for the second quarter of 2025. They are going to now delay that until 2026. Spirit is also going to furlough over 200 pilots starting in September. And this is all a part of the airline's cost-cutting efforts in order to save cash. And to break that down just a little bit further here, Spirit is saying here, Maddie, that the airline deferrals, or the aircraft deferrals, are going to boost liquidity by about $340 million. They estimate that over the next 2 years. And of course, this comes on the heels of the fact that their planned merger with JetBlue fell apart after it was blocked by a federal judge not too long ago. And this one quote from the CEO stuck out to me, CEO Ted Christie, saying that, of course, these steps aren't ones that we want to take, but they're necessary to ensure a strong and profitable future right now for Spirit.
Well, and it's interesting to note that originally off the news, Spirit was up as much as 5%, so seeing a positive reaction there to that cost cutting that you mentioned, Shauna. They also say they're going to furlough around 260 pilots, so some more cost cutting there. They're also going to have to ground some additional planes, these geared turbofan engine planes, GTFs, as they're called. And due to that grounding, Spirit is going to receive anywhere from $150 million to $200 million in additional compensation. So all of these different factors that you mentioned really beefing up this narrative that they are going to be able to handle some of their liquidity challenges a little bit more directly. Citi also noting that this could have a positive impact on their overall cost reduction, but also that potential revenue generation reduction could be a risk as well moving forward. So interesting to see whether or not this is going to be enough to push Spirit up in the future. Well, we're going to have all of your markets action right here ahead, so stay tuned for more. You're watching Yahoo Finance.
Don't look up, at least not without the proper attire. Eclipse mania has swept the U.S. Which businesses are looking to cash in? What is a solar eclipse? And what is the best place and time for you to get the best view of the astronomical event? Here is what you need to know. A total solar eclipse is when our moon moves directly between the sun and the earth. In cosmic terms, the moon is about 400 times smaller than the sun, but it is about 400 times closer to us. When these two celestial bodies are aligned, they give the illusion of being of equal size. Now the sky will get as dark as night and the temperature will drop. The total eclipse path will begin in Mexico, but will slowly move up north, touching down in Texas at around 1:30 p.m. local time. The celestial show will pass through 15 states, proceeding through the northeast until concluding for most viewers off the coast of Canada. Cities across the United States, including Dallas, Indianapolis, Buffalo, and Cleveland, will be the hotspots for the event. Businesses across the U.S. are looking to cash in on the craze. Delta is operating a flight that will follow the eclipse from Texas to Detroit. Pizza Hut has launched the Total Eclipse of the Hut campaign, offering any large pizza for $12. Sun Chips has a limited edition solar eclipse flavor, or it's pineapple habanero and black bean spicy Gouda chips. Krispy Kreme is even teaming up with Oreo for a total solar eclipse donut. And Burger King has a buy one, get one Whopper deal. According to a report from Time magazine, overall the event is expected to inject $1.5 billion into local economies that are in the path of totality.
And approximately 32 million Americans live within the path of totality for this afternoon's solar eclipse. That's going from Texas all the way up to Maine. But that doesn't mean people are not flocking to those areas that they can catch a potentially once-in-a-lifetime event at a little bit more clearly. Take a look at this map of Airbnb bookings for today. We're going to pull that up for you, showing across the country the number of bookings happening right along that path. You can see that orange line kind of cutting across the country there, with those increased bookings. And Shauna, just to pull out some of the crazy numbers that we have here, the occupancy across this path in Canada, the US, and Mexico was at 92% for the night of April 7th. That's up from 30% a couple days prior.
People are excited, and rightfully so, right? And many people, like you can see from that map, were planning ahead because they were doing all they can to best position themselves in order to take part within this excitement. So because of that, we saw that map that was just up on the screen. Car rentals for the solar eclipse up 3,000% along the path of the total eclipse here. So some interesting numbers, talking about millions and millions of people traveling to areas of the country where they are able, where they are going to hopefully, if weather cooperates, be able to participate at some point of the total solar eclipse that we are expecting later on this afternoon today. With our focus up in the sky today, it's easy to forget about how instrumental space technology is, not just for government agencies and intelligence industries, but also helping agricultural and foresting companies make better informed decisions. Joining us now to discuss all of this, we want to bring in Will Marshall. He's the CEO of Planet Labs. Will, it's great to have you on set with us.
Pleased to be here.
So let's talk about, first, we're going to talk about solar eclipse because we have to. Everyone's chatting about it today, and then we're going to get a little bit more into your business. But I'm curious, so when we talk about the excitement surrounding the solar eclipse, what exactly what impact does it have on your business? What do you do to prepare for something like this?
Well, we didn't have to do anything much. We could point our satellites back the other way and look at the eclipse like everyone else. It's funny, I'm an astrophysicist by background, but it's like you don't have to be an astrophysicist nowadays to find out where the solar eclipse is. You just look at the Airbnb bookings.
How far we've come.
How far we've come. Exactly. Newton would be proud. No, but it's one of the most phenomenal events that you get to see. I've seen a number myself, but basically, it just so happens that the moon is 400 times closer, but 400 times smaller. And so they happen to be the same size in the sky, even though they're totally wildly different sizes as objects, 400 times bigger. But it is one of those things that everyone reacts in a very bizarre way. Animals react differently, and we as part of animals also react differently when the sun suddenly blots out in the middle of the day. It's an exciting time to go and have a look. I hope the weather holds up for a lot of people to get a chance to see this.
Well, tell us then about how your satellites could interconnect with something like a solar eclipse.
Well, not much at all, to be honest. But we have seen, when we look down on the ground, we see the path of the totality as it races across the sky. But what we do as Planet is we have 200 satellites with cameras looking down. So I used to build telescopes looking up when I was working at NASA, but now we're building telescopes looking down, helping us to take care of the most exciting planet that we've ever found, which is this one. The Earth is an incredible ecosystem of life, and we are helping us to try to take care of it. So we image the whole Earth every day to take care of the planet.
When you talk about some of the work that you are doing, you build and manage a fleet of more than 200, just around 200 satellites that are capturing images here on Earth, daily global change on Earth. When you talk about, there's been so much hype surrounding AI, how it is disrupting, how it's revolutionizing across your industry. How do you see the advancements in AI impacting what you do? Yeah, absolutely. Well, a huge amount. Yeah. So AI is all about the data. Algorithms on their own are not worth anything. It's all about what data you train them on as to how useful they are to you. If you train them on the text of the internet, you can answer questions that you can find on the internet. We've got this corpus of imagery, 2,500 images for every point on the Earth's landmass on average. So to train our algorithms so that you can do things like find any object around the Earth across and backwards through time. Let me give you a very specific example, though, to make it concrete. We work with the government of Brazil to track deforestation. Now, we produce millions of images all the time of Brazil. No one could look at all those images by hand and check if the difference between today and yesterday if there's deforestation. So we have an automatic algorithm that's trained using machine learning that looks at all of the Brazilian Amazon and finds any new roads. If it finds a road, it's an early sign of people doing deforestation. We then send them alerts every day of all the locations across the entire Brazilian Amazon for deforestation events. Last year alone, they did 3,000 interventions to go and arrest people or take equipment. They confiscated over $2 billion worth of equipment, and most importantly, they reduced deforestation rates by 55% in Brazil, leveraging our data. So if you have a cooperative government and this sort of data set, you can have real impact on the world. So it's good business and it's good for the planet.
So talk to us about the interconnectedness then of AI helping your business and also the impact on our climate and our planet. Like, to what extent does the addition of AI help you in that effort?
Well, it's critical because, I mean, we use AI up and down the stack. But just to think about this, in the next few years, every company on the planet and every country on the planet is going to have to balance its carbon books. It's going to have to balance, just like at the end of the year, you have to balance your financials, you have to balance your carbon books, because we're going to need to, we have to be a sustainable planet. We have to move to a sustainable economy. Well, the first step is, how do you measure that stuff? And AI helps us measure that stuff, like the deforestation example and many others.
And real quick, I want to get to two things with you. One, you announced earlier today an expanded contract with PG&E, just in terms of the utility giant, what they're using your data set for. What exactly is that? Do you expect more of those types of contracts to come about here in the coming years? And then when you talk about some announcement that you have on deck for tomorrow, you're launching a new platform. What can you tell us about that?
Yeah, that's very exciting. Well, with PG&E, it's an expanded partnership. We monitor millions of miles of their power lines and for vegetative encroachment. So instead of having to send helicopters along their lines, we can tell them well in advance just using our satellite data. And again, that uses algorithms to detect those tree encroachments, and then they only need to send people out where they need to, rather than searching these long miles of lines. And that can stop wildfires. It can also help ensure electrical conductivity to the homes that they are serving. And yes, tomorrow we're launching a milestone launch of our platform. It's very exciting. It's a culmination of a lot of we did an acquisition last year. It's a culmination of the platforms coming together. I won't spoil all the details, but what I would say is that the goal is to help an ecosystem of partners to build on top of our data. We have all the data in there, but also some tools that enable them to build, because customers don't want just data, they want solutions. But there are millions of different applications, vast array of applications that are untapped with this new data set, all these images of the Earth. And we can't possibly, as Planet, solve all of those challenges or help all those applications and serve them all ourselves. So we're trying to enable an ecosystem, just like the App Store on Apple, to enable people to build their own solutions on top of our data.
Really exciting. Thank you so much for joining us and coming in studio. We really appreciate it. Will Marshall, CEO of Planet Labs, thank you so much
very much
for joining us. Now coming up, switching gears here because Treasury yields have hit a 4-month high. We're going to break down all of that for you and what it means for equities right after this. You're watching Yahoo Finance. Higher for longer seems to be the name of the game lately. The likelihood of rates staying higher for longer, pushing the 10-year Treasury yield to its highest since late November, as traders start to reassess the possibility of the Federal Reserve's timing of rate cuts. We're going to break down the latest moves in Treasuries with Leslie Falconio, head of taxable fixed income strategy at UBS Global Wealth Management. Leslie, thanks so much for being here to talk about all things Treasuries with us. As we were mentioning, yields are hitting 2024 highs. Equities still roaring ahead today. What are yields trying to tell us about the economy that equities might be missing?
Well, listen, I think it really depends on what's driving those yields, whether it's inflation or growth. And let's be honest, I mean, growth has been strong. It will be strong in the first quarter. We have GDP now and close to that 2.8%. We had a strong payroll report on Friday. So, the fixed income market is forward looking. But now that we have a market correction, which, by the way, we anticipated heading into the year. We really definitely felt that the market was pricing in much more of an overzealous Fed, meaning they had a cut in March. They had about 160 basis point cut throughout the year. Now they're back to 100% in, September, like a 90% in July. But it's the amount of cuts is only about 63 basis points now. So you're now actually less than what the Fed projections dictated in the March FOMC. So we do think around this 446, 450 level is actually a great time to buy and lock in for the long term.
When it comes to some of the movements that you're expecting to see after we potentially hit up above some of the resistance at the 450 level, what is going to be the catalyst to trigger that move? And I guess when we talk about the downside here, at least for yields, what do you think that looks like?
Well, when we think about, what could trigger the market moving higher? Listen, we have CPI on this week, but honestly, everyone knows the measuring or the lack of correct measurement when it comes to owner's equivalent rents and the actual rent. So, everyone expects that to converge. Obviously, we have to deal with oil prices going up. And if there is a reflation and if oil prices stay higher for a sustained period of time, that could be an issue. But I really think now it's that the focus is going to be on the other side of the mandate, which is on the growth side. And our expectation is that throughout the year, although it remains above trend, growth will slow, and that's what we believe. So to us, it really doesn't matter whether the Fed cuts in June or July, 75 or 50, as long as they cut this year, and as long as inflation's not priced in, then we do think that 10-year yield will trend lower, probably by the end of the year around that 375 level.
So what should investors be doing right now then, Leslie, if they're listening to this segment? Should they be getting in on the end of the curve today?
Yeah, listen, you're never going to pick the top, but we went to a 446 in 10-year yield. That's really close to the 4.5%. And, locking in at that level, you're what we call positive convexity in the sense that the amount of yield that you're locking in and earning creates such a cushion to the investor that, if we go anywhere near that 375 at the end of the year in 10-year yield, you're looking at a double-digit total return. Well, if we go up another 50, another 60, you might be flat in 10-year Treasury yield total return because of that income that you're earning. So it's really skewed to the positive side. And again, it's not just if the Fed cuts in 2024, then they're done. They're going to cut in 2025 as well. Although we are of the belief that neutral rate, if you will, is much higher than the 2.5% that the Fed's projecting, maybe 375. But the market's really putting in a lot of bearish sentiment. So we do like locking in terms of higher quality treasuries, agency MBS, some IG for the carry and the potential price appreciation. But spreads overall in fixed income have had an incredible 3.5 month run. And spreads are overall pretty tight. It's yields that are on the cheaper side.
Leslie, when it comes to the pricing action, what we have seen priced into the market up until this point, there has been some chatter, some strategists that we've talked to over the last couple of weeks that said that, hey, it's a bit too optimistic up until this point. But it sounds like you actually think the pricing action that we've seen up until now makes sense given the outlook and what you're expecting to see from the Fed.
Well, listen, the market has corrected quite a bit in terms of the amount of cuts. And when we think about how loose financial conditions are and how well spread product is done. When you think it's actually done quite well because the market's gone up to 446 from a 385 that we started at. The market started the year at 160 basis points of cuts. Now it's 63 basis points. But equity and fixed income, what we call assets that have higher credit embedded, have done incredibly well because growth is still strong. So, when we look at that, that's really been the driver. If it shifts to where inflation becomes a true concern, then it's going to be a 2023 scenario where those rising rates are actually going to hurt risk assets because it's inflation driven, not growth driven.
Leslie, I want to end by asking for some of your high-level advice for our audience of more retail investor-driven folks or maybe more invested in trading in the options space, day trading a little bit. How strong does your investor hygiene have to be to start to get into the bond market a little bit? And what should your kind of thinking be if you're just starting to get your feet wet with the bond market?
Look, I mean, listen, if you look at the past couple of years, cash has earned a seat at the table. There's no question, given the yield curve inversion. This is as long as we've been inverted. But the purpose of cash, historically has been capital preservation, liquidity, and yield. But yield has actually been the third slot. It's just been recently, since that inversion of the yield curve, it moved to first. But now that we think that the Fed will cut, that reinvestment risk is going to be, a big tailwind to those total returns. So we like to see people go out, take some of that cash alts, and start really locking in to actually lock into to have that true carry for a longer period of time. I mean, cash has been a great spot, but we just don't think it's going to last throughout 2024.
Leslie Falconio, great to have you here. Thanks so much for taking the time to join us this morning. Head of Taxable Fixed Income Strategy at UBS Global Wealth Management. Thanks, Leslie.
Thanks.
Keep right here on Yahoo Finance. We got much more of your market action ahead. You've got the Dow up 56, the Nasdaq up about just around 0.3%. We'll be right back. Well, Tesla shares getting a boost this morning as investors are keeping a close eye on the company's latest announcement. You're looking at gains of just about 4%. Well, Tesla CEO Elon Musk writing on X that the EV maker is going to be unveiling its new robo-taxi on August 8th. Earlier today on Yahoo Finance's The Morning Brief, I asked Tasha Keeney of ARK Invest about the announcement, how bullish this could be for Tesla. Here's what she had to say.
We think this is going to drive the future value of Tesla when we look out 5 years. We think it'll be 2/3 of the enterprise value in 5 years. So we're super excited about it. Can't wait for August.
For more on what this means for Tesla, we want to bring in Craig Irwin, Roth MKM Senior Research Analyst. It's great to have you, Craig. I have a feeling that you might disagree with Tasha just a bit. So she's making the case that she thinks this is going to account for about 2/3 of Tesla's enterprise value within the next several years. What's your response?
Yeah, fundamentally, level 4 ADAS will consume as much electricity as the drivetrain. There is, technically it's conceivable, it's feasible, but not on the vehicles that have been sold, and not in the format that anyone's close to today. So it is a non-starter unless they start doing things like millimeter radar and introducing LiDAR, and go with many more cameras that are much higher resolution than what they have now. So I think what we're going to be shown should really be called the cyber taxi. It was basically announced 2 years ago they're gonna have a built-for taxi market vehicle. And recent coverage in an interesting biography suggests that the vehicle's going to look a little bit more like the Cybertruck. So let's call this the cyber taxi. It's going to be a disappointment. There's no way this is going to be as funny as the dancing robot when Tesla announced they were going to crush what Boston Dynamics has done. I am not a believer.
Well, Craig, the market is seemingly disagreeing with you this morning because this stock was briefly up as much as 5% off of this news. So what do you think the market is trading on that you disagree with here?
So the market is a hopes and dreams measurement device, right? Tesla is a hopes and dreams stock. It's a growth stock, or at least it was until it started shrinking. So it has a very strong valuation. It is a retail darling, and people buy what they like, buy what they love, choose with their hearts. Professional investors follow momentum. They measure retail momentum very carefully. And the size of the uplift on this announcement will be measured by all my clients across Wall Street. And they'll put that in context versus the last announcements and decide how much they want to be long or short. Personally, I'm biased negative. I think the stock can get cut in half. I think there's more price cuts to come. I think that there's more margin compression. And this is a diversion away from the fact that the company is now shrinking. And oh boy, now they're doing advertising so that they can maybe grow sales, do it the traditional way an auto company does it. They are an auto company. They're a great company. They've done a phenomenal job with the technology company, with the technology for EVs, but it's a car company. This is not a robotics company. This is not an AI company. They're selling cars.
Craig, when you take a look at how Tesla stock has traded over the last several years, and it doesn't always trade in line with the fundamentals, and I think you could potentially, depending on how you view this upcoming announcement here about robo-taxis, but you could potentially make that argument just in terms of the uptick, the 4% gain that we're seeing today, if you're buying into the fact that, hey, maybe this is just part of Musk's playbook and he's trying to distract from some of the fundamentals of Tesla. But when you take a look at the momentum specifically in Tesla's stock, how does that differ from others within your coverage space, just in terms of the fact that so many of these investors are big believers in Elon Musk himself, and just simply getting excited about what could happen in the future is enough to make some investors buy at this point?
Yeah, no, so this is a very interesting one. So I've covered clean tech now for 25 years. And I cover a very wide swath of the EV and charging space, and everything from biofuels to energy efficiency to fuel cells. And many of these executives have known back 3 or 4 companies as they've progressed through their careers. Tesla is a very, very special stock, right? Number one, for the charismatic leader, the fact that Elon Musk is really a pretty amazing guy and has executed. He's not executed to his dreams, but he's greatly outstripped what he said what was expected of him originally. I remember the early debates of 20,000 cars. What would Tesla look like if they produced 20,000 cars, shortly after the IPO? It's an amazing company. The rest of the space has had challenges. There are some more mature companies. My colleague Phil Shen covers the solar space, where we see many more comparable companies, but nothing, in the hundreds of billions of market value. Overall, sustainability in clean tech has been sort of slow to gain traction, but is seeing really good traction across the board in different areas now. So retail loves Tesla. Retail does not love sustainability right now. And, Tesla is a special company for that.
Craig Irwin, always great to get your insight here. Thanks so much for hopping on with us this morning. We really appreciate it.
Thank you.
Let's do a final check of the markets. We're just about 90 minutes into the trading day. You've got all three of the major averages in the green. Looks like Wall Street trying to rebound from last week's losses. Again, a very busy week ahead for investors. We've got a number of key economic data points that are on tap, and also the start of first quarter earnings season.
Now, coming up, our new show, Wealth, dedicated to all of your personal finance needs. Rochelle Akufo has you for the next hour, so stay tuned for more.
Wealth, earning it, growing it, and managing it. It's more than tracking just the latest market moves. It's more than your favorite trending tickers. One does not simply build wealth without considering the entire financial landscape. It takes a community, and we've built one for you.
On today's show, Biden's new student loan forgiveness plan will break down what it means for your wallet, and navigating the great wealth transfer, tips and tricks for talking to your family about death and taxes. Plus, the hidden cost of EV ownership. We reveal the pros and cons of owning an electric vehicle. Hello and welcome to Wealth. I'm Rochelle Akufo, filling in for Brad Smith, and this is Yahoo Finance's newest guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and tricks you need to grow your money. Well, let's start with your wealth theme today. Intentional financial planning, how thinking critically about your financial future can help you make decisions about college, jobs, and beyond. Well, let's start with the Biden administration announcing new plans on student debt relief today that would cover over 30 million Americans when combined with previous actions the administration has already taken over the past 3 years. Now, this is the president's latest attempt to bring relief to millions of borrowers after the Supreme Court blocked his original debt cancellation plan last year. Well, here with more on these plans is James Quall, U.S. Department of Education Undersecretary. Thank you for joining us this morning. So walk us through, for people seeing this announcement, you're very welcome. What do they need to know about who is eligible under this new proposed plan versus some of these other government plans that are already in place?
Yeah, it's an exciting day here. President Biden is laying out today a new plan for student debt relief that, together with steps we've already taken, will reach 30 million Americans with some forms of debt relief. One major aspect of the plan is that we are helping people who owe more than they borrow because interest can often run away from them. And so we hope to finalize these plans over the next coming months. The next step for us is to publish them for public comment and to begin delivering relief this fall.
Now, for people who are wondering whether or not they qualify as having financial hardship, that was one of the gray areas in some of the messaging there. What do they need to know about who qualifies so people can see if that applies to them?
Yeah, well, we're taking a look now as we move through the process. All the information we have is on studentaid.gov/debt relief. So come take a look there at the questions and answers that we posted there. And while you're there, take a look at some of the benefits we already have. There are a lot of people who are eligible for public service loan forgiveness or who could save a lot of money by enrolling in the Save Repayment Plan. And we hope people will take a look at those benefits and take advantage of them.
And something else that was interesting, looking at the president focusing on the interest rate for some of these loans as well. How would we see that adjusted? How low could that potentially go?
Well, the adjustment we're making now has to do with really runaway interest. And we have people, in some cases, having made payments for years who still owe more on their student loans than they originally borrowed. And that doesn't seem right. So what the president is proposing today is to forgive extra interest up to $20,000 for everyone and the entire amount of interest for people who are enrolled in the Save Repayment Plan. In order to get them back to a fair place on their student loans. And that's something that will benefit 25 million people.
And for people who are wondering if their school applies here, because there is some language, at least in the announcement, saying some schools that perhaps had closed while people are still paying, their student debt on this. What do they need to know and whether or not they qualify?
Yeah, one of the things that this administration has done quite aggressively is go after colleges that leave students with debts they can't afford to repay or, unfortunately engage in predatory marketing or other types of bad behavior. And when we close down colleges, we're protecting future students, but we need this rule to make sure that past students who were cheated by their school also get relief. So I'm really happy with this piece of this provision who will help people who really need it.
And I have to ask, of course, we saw that the 2003 HEROES Act that the president relied on with his initial relief plan, that was tied to some of this emergency relief that he tied to the pandemic, something that we saw after 9/11. But this time they're using the Higher Education Act. How much more likely is this to survive than the last edition of this student debt forgiveness plan?
Yeah, well, obviously, we studied the Supreme Court decision very, very carefully. And we are using a different authority. We used emergency authority related to the pandemic last time. And obviously, everyone in the country was affected by the pandemic, and we were able to deliver loan relief to nearly everyone. This is a different approach. We're using the Higher Education Act. That's a statute that's been around since 1965. And we are targeting our relief on specific problems that people are experiencing, like runaway interest. And, it turns out a lot of people are struggling with their loans for a lot of reasons. So we'll be helping a lot of people with these plans.
And of course, a lot of people wondering when they're going to see these plans implemented, when they'll start seeing it. Plus, we are in an election year, creeping up closer and closer to November. What are the expectations there?
Yeah, well, we are going through a regulatory process. That's another difference from the first plan. This requires us to go through a lengthy process involving public comment, and we do take that seriously. We'll be publishing this proposal in the coming weeks and responding to all the public comments we get. Our goal is to finalize these plans and begin implementing the interest benefit this fall.
I appreciate you taking the time to join us this morning. James Quall, U.S. Department of Education Undersecretary. Thank you so much.
Thanks for having me.
As you heard there, President Biden's new student debt relief plan could end up covering over 30 million Americans if implemented. But will it also help Biden's chances at the polls? For more, Yahoo Finance's Rick Newman here to discuss more. Hey, Rick, so never want to shy away from your thoughts. So how do you think this is going to be received?
I'm sure the Biden administration hopes it gains them some credibility with younger voters and people who are struggling with this problem. But Biden clearly is backsliding with younger voters, and he needs them to win. Remember, he won by a very small margin of popular votes in just a handful of states back in 2020. So he cannot afford to lose that margin. And also worth pointing out, some of these benefits will go if these proposals actually get enacted. And I think that's a very important caveat here. Not necessarily younger voters, but to people who have been paying on their loans for 20 years or even more. So, and the administration says this new batch of programs would help about 25 million people. So that is a substantial number of people. Just to put this in context, Rochelle, the original debt cancellation plan, which was sweeping, would have helped about 44 million people. The Supreme Court obviously shot that down last year. So in the meanwhile, the Biden administration has been rolling out these targeted debt relief programs that have helped a few million people so far. So if this stands, it would be a big increase in debt relief for these people. But, important to emphasize here, as the secretary pointed out, these are proposals at this point. That none of these are in place yet. And my guess is that some of the, one or two of these might be in place by election day, but probably these are still going to be proposals come election day in November.
And you raise an interesting point here, because obviously this is for people who've been paying for 20, 25 years. That isn't that younger voter demographic that the Democrats are hoping to tap into. But then what happens to student debt if Trump takes office in November?
Who knows? Since the Biden administration is doing this by basically by regulation rather than legislation, that means Trump could undo it if he wanted to. So I'm sure now that Biden has rolled this out, people are going to be asking Trump, well, what are you going to do if Biden rolls this out and you actually win in November? I don't think Trump is going to say, oh, I disagree with this. I would kill this the moment I get into office. But he could kill it without saying so, because you can slow roll regulations. You can keep regulations on the books, but not enforce them. You can, not finalize the process. And I think this is something where we're going to hear Joe Biden as the candidate trying to distinguish himself from Trump, saying we're going after this aggressively. Trump was president for 4 years and he didn't try to do this at all, which is true. Trump didn't do any debt cancellation, and I'm not sure he ever even talked about it. So, but Biden, look, he's tied. He's pretty close with Trump, and he's losing in some of the polls. So there's definitely a political element here. He's trying to gain some credibility with voters, and if he plays it right, he might be able to.
Yeah, you never know. Some division there of the people who already paid off their student debt saying, what about me? But that is how some of these regulations work. So appreciate you getting us up to speed. Our very own Rick Newman.
See you, Rochelle.
Of course, we are in an election year. Americans will witness a rematch between President Biden and former President Donald Trump. And you might be wondering the impact an election might have on your finances. Well, here with more on investing during times of change is Nora Youssef, RBC Wealth Management Financial Advisor and Senior Vice President. Thank you for your time this morning. So usually we don't tend to see the markets move a lot, depending, because they usually have picked their sides in terms of being slow and steady and really having a lot more foresight. But if you're looking at your portfolio, what should you be bracing yourself for?
Well, just know a lot of people, when they hear election year, they get fearful and are tempted to put money under the mattress. But know that election years are surprisingly a positive thing for markets. In fact, they tend to follow a similar pattern. And that pattern is that as the market is leading up to the election, it gets volatile as emotions run high and headline noise reaches a fever pitch. But by the end of the year, once a president is elected and the market gains certainty, which it likes, since 1928, the market has ended higher than it started 75% of the time. And if you're looking since the 1950s, the stock market has ended higher than it started 83% of the time. And it's typically up over 7%. And the same is true, regardless of a Republican or Democrat winning, Trump or not Trump, controversial election year or not. We've been through them before. So in general, just know that it's the Fed, earnings, and where we are in the economic cycle that moves markets, not presidents. So in short, just don't let how you feel about politics affect how you feel about investing.
And do we tend to see people investing from some of their political beliefs?
We do, and it's unfortunate. When it comes to this political cycle, when you think about it, presidents, again, don't affect the S&P 500 earnings typically, or the $28 trillion economy that we have. And during this economic cycle, sure, this presidency, you could argue, well, the Tax Cuts and Jobs Act, that's going to be expiring at the end of 2025. And that's true. And that likely will move the markets temporarily, but longer term, it really presidents have a very minimal effect on the market.
And of course, you mentioned the Federal Reserve there. A little more hesitancy we're seeing from investors about the rate cuts, the pace of rate cuts that they were hoping for this year. What should people do then if they were expecting these rate cuts based on that news, and then now they're really not so sure?
Yeah, so what I would say is don't risk your cash having FOMO, because the rates have been standing steady and they're likely next going to be going down. And so this window of opportunity to essentially cash in on these rates at 22-year highs is going to be closing. So if you haven't yet, make sure you've locked in your cash at bonds or CDs or Treasury bills, fixed income, and go out longer term, as long as you don't think you're going to need that money, whether it's 1 year, 2, 5, or even 10 years, because you don't want to wait another 22 years to put money at work.
And so for some of these perhaps riskier assets, is now a good time to do that when you already have, there are global elections going on everywhere and still waiting to see what happens with interest rate cuts. What sort of mindset should people enter the market with now?
Always keep a long-term approach when it comes to the market. Even wars, for instance. We have a lot of change going on. We've got the election, we've got wars, we've got interest rate changes. But know that even with wars, as humanitarian aspect of things, of course, it has a devastating effect from that standpoint. When it comes to the markets, again, it's a short-term effect. So it's good in all of these cases to keep a long-term perspective. If you've already invested, and assuming you've got quality holdings that are diversified, you want to stay the course and don't get rattled. If you have some cash on the sidelines, consider a dip, a potential opportunity to do some buying. But all that, take with a grain of salt and be wary of trying to time the market. Because if you miss just the 10 best days in the market over the past 20 years of the S&P 500, for example, you could cut your returns in half. Instead of getting over 10% returns over time, you're only going to be getting around 5% if you miss those 10 best days. So as tempting as it is, try to avoid timing the market, because it's time in the market, not timing the market, that counts.
Indeed, got to keep a steady hand when things are looking rocky. Appreciate you joining us this morning. Noura Youssef, RBC Wealth Management Vice President and Financial Advisor. Thank you so much.
Pleasure.
All right, coming up, from the best markets for first-time home buyers to finding the right job for you, we'll be talking about how to navigate some big life choices after the break. The housing market is notoriously hard to navigate, and for first-time home buyers, it can be even more challenging, especially within this economic backdrop. New data for real estate platform Zillow is pointing to the Midwest as potentially the best region for buyers looking for a new home. Let's bring in Yahoo Finance's Danny Romero to break this down for us. So, Danny, how did they decide this?
Well, there's several factors that go into this before Zillow comes out with this report. So they really rank it based on rent affordability, the share of listings that a typical household can afford, and expected competition for these homes, and the number of similar aged families that are within that region. But St. Louis is taking the hold right here. They are the best market to buy a home, especially for first-time home buyers who are dealing with that affordability constraint. Other cities on Zillow's list include Detroit, Minneapolis, Indianapolis, Austin, Pittsburgh, San Antonio, Birmingham, Baltimore. And the reason why St. Louis came in the first place is the median home price is about $200,000, Redfin reported, and households in this area are spending about 30% of their income on a monthly mortgage after a 5% down payment and a 7% interest rate. So the average mortgage payment is about $1,400, and a local brokerage owner in St. Louis told Yahoo Finance another great reason to move over to St. Louis is the great school districts, and there's lots of fun activities to do for free, and that's really good for families, especially first-time comers. Now, if you aren't ready to buy just yet, the Midwest is still a great option to live. Rent is affordable. Rent is about $1,300, and that's lower compared to the national average of $2,000. So that really helps renters save for a down payment. And don't worry too much about inventory. Competition isn't as intense. For example, there are about 3.4 affordable listings for every 100 renters. The downside to St. Louis is only 26% of households are about 29 to 43 years old. And that's a lot lower than Austin, Texas. That's about 30% of households are about the age of 29 to 43 years old. Rochelle.
All right, still some goodies to be found there. Appreciate you breaking that down. Our very own Danny Romero. Well, if you feel like you've gone down the wrong career path, it's not too late to make a change. If you're feeling unfulfilled in your job, well, it's normal, but you deserve a career that brings you purpose and a paycheck. So how exactly do you kickstart your journey to finding meaningful work? Here to help is Ken Coleman, host of The Ken Coleman Show and author of Find the Work You're Wired to Do. I love this topic very, very much here. So first off, in terms of how you even find work that you consider meaningful to you, where does that thought process even start?
Yeah, so it's all about self-awareness. The more aware we are of how we are designed, and that's why we've called the book Find the Work You're Wired to Do. We think that there are three wires that we can say confidently that everybody has. The first wire is what you're really good at doing. We all come in with into this world with talent. So these are things we do well. Think of skills. And then the second wire is what we love to do. This is work that we look forward to and work that when we're engaged in it, time seems to disappear on us. And then the third wiring is about results. Everybody wants to make a difference in this world. And so what motivates us? Well, what we know from psychology research is that there are results that we all care deeply about. And when we can figure out how to use what we do best, that's the talent piece, to do what we love, that's passion, to produce results that matter to us, mission, now we can see a lot of work out there and we see where we are a good fit. And that's huge. We don't teach this like we ought to in our homes or in the classroom.
So Ken, let's break some of this down, because sometimes it might be that the thing you love might not particularly be good for a career, maybe a side hustle. I had a boyfriend who thought he was hilarious, wanted to be a comedian. He was not funny at all, but like, how do you break that to people who really aren't self-aware?
Yeah, this is a really good question, and you make the very good point. You have to be self-aware. Can I be good enough at this to actually get paid for it? If the answer is no, then it's a hobby. It's a labor of love, if you will. And so that's really important. And back to those three wires. I'm good at it, I enjoy it, and it produces a result that I care about. So the self-awareness comes into, again, people will pay me for this because I'm good enough that they actually want to pay for it. So in your boyfriend's case, you know, look, if he stays with it and stays with it and stays with it and stays with it, maybe he can get paid to be a comedian down the line.
Yeah, he's an ex-boyfriend for a reason. That did not pan out. He was not funny. But
Good
for those who do, for those who do have a skill and they're like, okay, look, there might be a market for this. What are the steps that you take from saying, I'm good at this and I enjoy it? It could be profitable. How do you go from that to turning it into a paycheck?
That's right. So now that we know what we're good at doing, we want to now look at what can we do and where can we do it? And this is looking at the marketplace to see, all right, I'm a good fit for this type of job, for this potential path. And so now it's all about getting qualified. So what is it that I need to learn and what is it that I need to do? This is education and experience. So we ask these questions first. Now listen, as the world evolves, and you're reporting on this, I'm sure, every day, companies are requiring less and less degrees for the type of work that in the past they've required degrees for. So we want to ask the question, is it a certification? Is it an online class? Is it a boot camp? Whatever it is, does it require a degree? And if the answer is no, that's going to save you a lot of time and money. So what do I need to do? What do I need to learn? Then what do I need to do? What kind of experience do I need? A lot of people call the Ken Coleman Show going, hey, I've applied for this, but they're saying I don't have enough experience. Well, it's because you're applying for something a little too high up the ladder. So where do we get in? There's entry level for every position in every career path. So those are the first two questions. Now, once we figure out what is it that I need to learn and then do, that's education and experience, how much are both of those ventures going to cost me? What's the hard cost of my time and money to get qualified? And then that allows me to figure out what my expectations should be. So maybe this is a 2 to 3 year path. And if we set ourselves with that mindset of being realistic, now all of a sudden we'll have that resilience to finish it. And that's where so many people, Rochelle, just get off the path because they don't answer those questions. What do I need to learn? What do I need to do? How much is it going to cost? And how long will this take? Because if I get the answers to those 4 questions, I've got a plan and I can stick with the plan. But absent of those answers, it feels very intimidating and confusing.
And you raise a good point about the timeline. I think some people perhaps try something and if it doesn't work out right away, they're like, okay, it's just not for me. So when people are looking at that, perhaps that 2 to 3 year time horizon until they're in a good space to do that, what should they be doing to build up their credibility while they're also getting some of that education and the skills training?
Okay, I love this question. They need to be connecting. Now, we call this networking kind of in the broader scheme of things, but that can feel very gross, like you're just this relationship vampire where you're always out trying to find an opportunity and you leave people for dead once you figured out whether they can or can't help you. No, this needs to be a spirit of I'm showing up and having as many coffees and as lunches and dinners as I possibly can with people that are in the industry that I want to be in, people that are further along than I am, and I'm showing up with the spirit of a student to ask questions, to learn. What did they do to get where they are? Are there some people that they think that I should connect with? Are there some places where they think I need to be, online or in person? And so this is a process of connecting because I'm learning about the right people in the right places, and then I'm getting an opportunity to do something with that knowledge. See, this builds credibility through relationship, humility, and then all of a sudden you'll be surprised at how many opportunities will come to you in advance of you actually getting qualified. So while getting qualified, you're getting connected like it's a full-time job.
Lots of great stuff there and adding some very important context, parts of this that people don't always talk about. Appreciate you taking the time this morning. Ken Coleman, host of The Ken Coleman Show. Thank you so much.
Thank you.
All right, coming up, we're talking about death and taxes. Well, kind of. We'll explore how you can transfer your wealth to set your family up for success. That's right after the break. For many Americans, the daily cost of living have made saving for retirement a struggle. They've paused contributions to retirement accounts, pared them back, or dipped into these funds. So what does this mean for your financial future? Well, Yahoo Finance senior columnist Kerry Hannon is here to weigh in. Always good to see you, Kerry. So walk us through what's happening here.
Hi, Rochelle. Yeah, I mean, the thing is, we hear all this great news about how the robust stock market is really, people's retirement accounts have blown up and we have all these new millionaires in their 401k accounts. And that's a fabulous story. We love hearing that. But there's a flip side, and there are these individuals who simply the rising costs have been relentless. Yes, we know inflation is slowing down, but it certainly isn't going away, and it's already jumped up significantly for groceries, gasoline, rent, all the things, the necessities. And so these studies that from Allianz and from Vanguard, from Betterment, they're all showing that people have, in fact, really cut back their contributions. In fact, I think Allianz was like 7 in 10 have cut back contributions, as well as, dipped into their retirement accounts. And, Rochelle, why this is a problem is because we see numbers now. The census is saying that in the next 3 decades, the number of people over 100 is going to quadruple. So come on, we've got to be saving. And the things that are stopping people are really troubling in the sense of the long-term growth of their retirement savings. And so I worry about younger people having trouble, contract workers trying to get in. You got to figure there's something like 56 million Americans that don't have an employer-provided retirement account. And what that means is you don't have someone automatically signing you up for a retirement plan or automatically taking that pay out of your paycheck and putting into your retirement account every pay period. And that makes it a real struggle for people when they have to make that voluntary decision. In fact, Vanguard found that people that automatically have retirement savings taken from their account by their employer save 50% more.
And Kerry, it's tough when you have sort of these emergencies that come up, or even to pay for groceries, and you're like, look, I can afford to pinch some here from my 401k, but they're not really thinking about the long-term or compounded impact that has. What are some alternatives that would still allow them perhaps to not have to take that route, but still allow them to stay a little bit more afloat?
Yeah, I'm so glad you said that. It is the compounding thing, isn't it? I mean, it's so hard to see the big picture because you go like, this is my money. I need it for these, immediate costs. It's a really tough trade-off. And so I think there are a couple of things happening here. I think number one, Rochelle, there are some new laws that came into play this year that now employers can look at your student loan payments. They can consider them as contributions to your retirement account, which goes into the equation for an employer matching your retirement savings. That's going to be a big help for people. The second thing is they have the green light now to pair emergency savings accounts with your retirement plan. Not every employer is offering this, but they may down the road. This is starting that process. Those are good things. The most important thing I encourage everyone to do, and I know you do as well, is financial literacy. So simple things you can do for free. Run those retirement calculators that you can find on AARP, on Vanguard, on Fidelity, Schwab. They're free. Just get an idea of what your picture might look like, no matter what age you are. Run those numbers, and it might help you get an incentive and understand how big this decision is. You might tap into a free online education and financial matters. University of Michigan has a good one. You can find some great per-fi books, as I call them. Mark Miller has a book, Retirement Reboot. All of these things can help. And ask your employer. More employers are offering financial wellness programs where they can help you learn about finances. I met a young woman who's 25 and she just opened her first Roth IRA. She had not been able to save for retirement. She didn't even know what they were, that they existed before that, because no one told her. So I think we need to drum the beat, get the message out. People need to learn as early as they can about finances and the things that will have impact on your future.
Indeed, we certainly can't scare ourselves out of looking at reality and trying to find some solutions here. Appreciate you as always, Kerry. Great stuff. Thank you so much.
Thanks, Rochelle.
Well, thinking about your future finances, we're setting you up for success. You can't take the money to the grave, so where is your money going once you're gone? Well, 48% of Americans plan to leave an inheritance, but about a third are not planning on talking about what they're leaving behind with their families. That's according to an Edward Jones report. So to break down how you should have the talk with your family, Lena Haas, Edward Jones Wealth Management and Solutions Head, is here. Thank you for joining us this morning. And so this idea that people plan on transferring their wealth but don't plan on talking to their families about it, how do you even start those conversations then if people are so uncomfortable talking about their wealth transfers?
Thanks for having me. Great to be here. Yes, you are absolutely right. One of the interesting findings is that close to 85 trillion is going to be passed down from silent and baby boomers generations to the young generations between now and 2045. Absolutely astounding amount of wealth, and that those conversations are not happening. And one of the reasons that we see this is the case is because it is an inherently emotional topic that oftentimes both givers and receivers associate with complexity, death, potential of harming relationships between family members. And so it is so critical to change that dynamic and make this a conversation about the transfer of wealth and values and caring for each other away from those negative associations.
Yeah, it's true, because I mean, once we're gone, that wealth is going to go somewhere. So at least by taking control of these conversations, it does help get that started. So what are the initial steps people should take when preparing for a wealth transfer?
Yeah, so the first one is to realize how important it is to have a transparent conversation with the family members, because it can make all the difference between leaving a legacy that's about anxiety or unanswered questions and resentment, or really living a legacy of love and care for family members and others. And in thinking about this conversation, it's important to have it as an information exchange in a neutral setting. So don't talk to your family members as a surprise over Thanksgiving dinner. Rather, understand who you should invite into the conversation, set a neutral place where you won't be interrupted, develop an agenda. And we saw that more than half of the participants told us that engaging a financial professional, such as financial advisor, to be that neutral moderator and coach really helps with the discussions and makes them much less emotional and more action-oriented.
And so, Lena, for people who are saying, look, I perhaps don't have as much to leave, maybe I don't need a financial professional, they've had side conversations but haven't actually put anything in writing, what should people be aware of when they're deciding whether or not they need a financial professional versus another means of transferring wealth?
So that's an important question, because the way that people define transfer of wealth is really beyond dollars and cents. So somebody might think, well, we don't have enough, but perhaps beyond the dollars in the accounts, they have real estate. Maybe they have family business and need to think about succession. And then beyond that, we see how important it is to discuss the overall family values. What do we want to be known for? What is our approach to charitable giving? What is our approach to responsible financial behaviors? So we find that it's incredibly important to have that transparent and regular conversation with family members, regardless of exactly how much you have to give.
And then obviously a lot of different family dynamics there. We're seeing more instances of people not giving to their adult children, but perhaps instead leaving something to their grandchildren. What should people keep in mind as they're having these active conversations? We're living longer and some of these family dynamics are changing.
Yes, longevity has a big effect on that. So in addition to the traditional giving, we also see that many choose to skip a generation, and maybe their children are already financially all set. They want to help their grandchildren get established, paying through education or perhaps contributing to a down payment on a house. We also see the rise of the giving while living trend. So how do you spend the time and money with those and on those that give you joy? So maybe this is taking family on a wonderful vacation, or again, contributing to paying off their debts, buying a house. And in those scenarios, what we see is that it's just so very important to have a transparent conversation so that children and other potential receivers, they don't get left wondering why. They understand and appreciate the intent of the givers.
That's very important. Nothing worse than, leaving this world and leaving your loved ones with all sorts of questions. I appreciate you taking the time to join us this morning. Lena Haas, Edward Jones, Wealth Management and Solutions Head. Thank you so much.
Thank you.
All right, coming up, the hidden cost of EVs. JD Power tells us all about the hidden issues that come with buying an electric vehicle. Plus, how do the rich celebrate the solar eclipse? Yahoo Finance's Ines Ferret reveals the answer on the other side of this break. EV adoption is in the slow lane, with sales growth falling in the US. Just last week, Ford said it's delaying the production of some of its North American electric SUVs and trucks as it waits for the market to mature. Well, as more people purchase electric vehicles, pain points are coming to light, including hidden costs that may not have considered. Well, joining us now on this is Ashley Edgar, J.D. Power Director of Automotive Supplier Benchmarking and Alternative Mobility. So, Ashley, a recent study of yours found that one thing weighing on EV owner satisfaction is faster tire wear. We don't usually hear about that. So, what can you tell us about it?
Yeah, so thank you for having me. So what we're seeing is that EV owners have similar expectations in terms of tire wear as gas-powered vehicles. However, when we ask them about their tire wear, they're running out twice as fast. So when we look at it, there's a difference between expectations, roughly 18% in terms of what they think they're going to get versus what they actually get, ICE versus BEV. But when the difference comes in, we really look at the actual replacement time, and there's a 53% difference. Telling you a little bit about the study, though, we look at the satisfaction of original equipment tires. So the tires that come on the vehicle when you purchase it at 1 and 2 years of ownership, looking at wear, ride, traction, handling, and appearance. So really where the surprise comes in on EVs is on wear.
So actually, why is there such a difference then in terms of the expectations in tire wear between your ICE vehicles, your BEVs, and your EVs?
Yeah. So I think it's the lack of communication when owners purchase their vehicle. They're not aware that the tires are going to wear out faster, right? So when you purchase the vehicle, there's no one at the dealership saying, hey, these tires are going to wear out differently than maybe an ICE vehicle that you purchased previously. So it's that communication that needs to be improved.
And so when people are looking at their overall purchase of an EV, obviously we're seeing some of the pricing come down, seeing, some of these starting to advertise more, but it's not just the cost of the car. Of course, you have the interest rate, you have the auto insurance, the entire cost of the car. How well factored is that when people are making these purchases?
In terms of the tires, I don't think it's being talked about at all, honestly. There's a difference between manufacturers. If you look in, your owner's manual, it's going to be different depending on the vehicle that you purchased. So I think it's something that the customers need to advocate for themselves at the dealership to really ask about what other costs are they going to expect when they buy an EV.
And so for people who say you bought an EV at a Tesla where there aren't traditional dealerships that you go to, how difficult is that then in terms of really meeting those issues and having some face-to-face contact with the dealership?
Yeah, I think it's just, going to have to be self-advocating, going online and understanding what others are experiencing. That's half the reason for our study, right, is to try to help educate consumers about what people are experiencing and us trying to understand what people are satisfied or dissatisfied with.
I appreciate you taking the time to join us this morning. Ashley Edgar, J.D. Power, Director of Automotive Supplier Benchmarking and Alternative Mobility. Thank you so much.
Thank you.
Well, while many of us will be watching the eclipse from our humble homes or even the window of our office buildings, the rich get to experience it all from the lap of luxury. Here to tell us how the other half lives is our very own Inez Ferre. So Inez, what are the rest of us missing out on?
Yeah, that's right, Rochelle. Well, it's great to be rich, and you can take these adventures and go to certain places to watch the solar eclipse. So let's take a look at the trajectory. We have a full screen for you so you can see that Airbnbs along the path of the total eclipse in its entirety. Those are full by about 100%. From Texas to Maine along that path, you can see the Airbnb bookings. But look, there's special trips that are taking place, 5-day eclipse trips to the Texas Hill Country. That costs about $5,000. TravelQuest organized a 12-day trip costing around $7,000, touring across northern Mexico. And then you have a cruise ship that's a $1,400 trip. That includes gazing at the eclipse off the coast of Mexico. Now, this eclipse is slated to last anywhere between 3.5 minutes and 4 minutes. And you can see it all the way from San Antonio and Dallas, Texas. You can see it in Oklahoma and Indiana, a slew of states. And there you see in Mexico, people gathered to watch the eclipse. I will say that my sister actually did go down to Texas, but she got an Airbnb with her husband, and they were going to watch this. So look, the next one is in 2044. So definitely people are paying top dollar to go watch it at these destinations.
It's true. Worth keeping in mind. A few minutes, but again, if we're not going to see it for another couple of decades, perhaps worth it.
Yeah, but if you do see
always.
it, just watch it safely with those special glasses.
Yes, please do. Don't want anyone having any eye issues after the fact. Thank you, Inez, for breaking all of that down for us. All right, coming up, gold and Bitcoin are pushing higher, but does that mean they belong in your portfolio? Much more on wealth after the break. Watching gold prices sitting above $2,300 as investors await this week's inflation print. And of course, digital gold also climbing higher, Bitcoin now sitting above 71,000. But this may not mean they belong in your portfolio. Yahoo Finance's Jared Blickery has the breakdown. Hey, Jared.
Hey, Rochelle, and let's just take a second to look at the performance this year. I'm doing this through ETFs as proxies, but gold up almost 13%, Bitcoin up over 50%. And by the way, this compares to the benchmark. That would be the S&P 500 in stocks. That's up about 10%. But we want to talk about some of the risks and some of the rewards in both Bitcoin and gold and in crypto more generally. So the first risk that we're looking at in crypto is volatility. And we know that crypto is no stranger to volatility. It works to the upside as well as to the downside. If you're not comfortable in your position, you can get shaken out pretty easily. And Bitcoin has seen a number of 75% to 90% corrections in its short 15 or 14-year history. So another risk to keep in mind is security. Crypto can be difficult to secure. If you're able to store it yourself in cold storage, that can be a plus, but you can also lose those keys. So if you store it in a centralized exchange like Coinbase, that can be a bit more secure, though ultimately you don't have as much control if you store it yourself. Now, we're also taking a look at regulatory risk, and we've seen that ease recently. When Gary Gensler headed up the SEC 4 years ago, there were large expectations that he was going to be friendly with crypto. Didn't really happen, but we finally got those spot Bitcoin ETFs, and finally we see those spot Ethereum ETFs on the horizon here. Now, crypto rewards are decentralization. This is a huge plus that somebody who might reside in a country where they don't have the ability to hedge their currency risk, they can buy Bitcoin, maybe. Sometimes you might have to do it through a specialized dealer or through a VPN account, but it is possible and it gives options. But I should also say that's the same ability that it gives criminals to use it for nefarious purposes. Now, liquidity is another one. Bitcoin never sleeps. It trades 24/7. So at 2 a.m. on a Saturday, you can buy and trade Dogecoin, but you can't necessarily do that with stocks. So that is a plus right there. Then high return potential. I was talking about volatility before, works to the upside as well as the downside. This is to the upside. Let's talk about gold now. I talked about market fluctuations with respect to, and that's volatility with respect to crypto, works with gold as well, although we see gold volatility increasing with price. That's a little bit different than, it's actually the opposite than stocks. Storage and insurance, you got to store this stuff and you got to pay somebody to protect it, whether you're a sovereign nation or you're an individual investor. So storage and insurance are definitely risks to consider. Limited use, gold is one of the universe's most finest conductors, but we don't use it a lot, mainly because of its price in electrical equipment. So that is one thing to consider outside of its safe haven. And this is one of gold's rewards. It is a safe haven. Investors turn to it in times of trouble and in times of inflation. It's a physical asset, so you can hold on to it. That's in contrast to cryptocurrency. Finally, diversification. Lots of portfolio studies over the years have showed that a portfolio with stocks, bonds, and gold or some form of commodities, even crypto, can be more diversified and provide better long-term risk-adjusted returns. Guys.
Certainly always important to know that risk. Appreciate you, Jared, so much. Well, that's it for me, but stay tuned for more wealth tomorrow. Stay with us on Yahoo Finance.